So yeah, once again, thanks everyone for joining, taking time out of your Saturday to attend. This one is going to be the last one for the year. 2 weeks from now ends up on Christmas, and then the next Saturday following that is January 1st. And I don't think people want to be attending these on those days. So once again, thanks for joining. A couple of points to start. I am not an investment advisor. Everything here is my opinion. It's what I do to look at stocks, to look at the macro, to look at what's going on in the oil and gas market. I'm not recommending any stocks. We've picked 3 stocks here to value today. One is Enerplus, given that we had the retail investor meeting with the CEO last week. CNRL is one name that was kind of discussed in the large cap versus small cap discussion last week. And then IPO, InPlay Oil is kind of a new one to me, but it was one that a lot of people mentioned on the Twitter post. So looks like a good one, and I'm pretty happy to share that one. The macro outlook today is again more in detail than even last week. I think one of the biggest things that we need to get through this volatility is the macro outlook. If you have conviction on the macro, you can sleep at night much better holding these equities through these volatile dips and job owning and such from the U.S. administration, the worldwide data that's coming out on this variant and such. So going to be spending a little bit more time on the macro, and yeah, we'll get started. I did send out the files in an email. I don't know if everyone is on the email list, so if you're not, we're going to be needing the corporate presentations and the Q3 results for each of those companies. And then if you want to follow along with the valuations, the Excel file is on the website at the bottom of the homepage. You can just download it and follow along when we get to that part. So we'll get started on the macro. So the screen is being shared, correct? Yes. So some topics will be on the macro side. Yeah. So on the macro side, we'll have a little bit about the pricing, where we are today, inventories, demand, supply, and then we'll move on to the valuations. So we'll get started right away. So on the top chart, we have your WTI 5-year chart. We had a little bit of a dip here last week when OPEC decided to open their taps a bit and add the extra 400,000 barrels a day down to 62. We have recovered very, very nicely from there, up about $10 from there in a short time frame. The data that I'm seeing coming out of this variant, I mean, some people like to have this risk-off view on things, which is totally fine. The data that I'm seeing does not concern me, and as a long-term holder looking into the future, into the structural supply and demand kind of issue that we're having with the oil industry, it doesn't really faze me. We're still sitting at about the 5-year high on WTI. Natural gas has dropped quite a bit with the warmer weather that's out there. That being said, we're not seeing really bearish injections either. It's still holding up pretty good. Power gen demand for natural gas is running considerably higher than last year, and we still sit at the top of our 10-year range for gas. These are prices that we haven't seen for a long time stabilize in this kind of range. So it's still looking pretty good on the natural gas front. I'm not gonna comment more on that. I don't follow natural gas as much as I do oil, but there's cases to be made for both sides. On the WCS side, we're looking really good. We had a problem here with the BC floods and Trans Mountain being shut down, and some other concerns about refinery maintenance and such. And I think those are behind us now. We're rebounding very strongly. The dips in Hardisty have gone down. The dips on the Gulf Coast have gone down, and looking strong as we go. There was a report out of Mexico here yesterday that they're not going to be exporting as much oil by roughly 200,000 to 300,000 barrels a day coming into next year. So the heavier crude is becoming more and more wanted. given that a lot of refineries are built to handle these heavier blends. They're not built to handle this shale light oil WTI stream all the time. So that is a good sign for Canadian producers. On the Canadian gas market, we see, again, the same thing. It has gone down a lot given the warmer weather that we've had. That being said, if you look at the futures curve, it really has not shifted that much. And compared to a year ago, we're still looking really good. I think if you go 2 to 3 years back and you told a producer that they could sell their summer gas at $3 and hedge it, I think they would be very, very happy with that. So, the market overall is looking strong. Alberta in particular is converting a lot of their coal-fired electricity generation into natural gas-fired generation. The oil sands producers are demanding more and more gas for their operations. So it's looking good overall. And we'll kind of see how this curve changes if we have this, some sort of polar vortex or cold freeze come in, and could be a nice little boost from where we sit today. Coming back to the U.S. crude inventories, we are at 2013 and 2014 levels, so well below the last 5 years average, and it continues to decline. We are seeing demand in America is looking really good, as I'll talk about it here in a little bit. And our inventories are sitting low. And from 2013 to 2014, demand has gone up. So if you look at the crude inventory in terms of how many days of demand can we supply from this inventory, we're sitting below 2013 levels. And that's when oil was $140, $120, and it stayed consistently above the $100 range, $90 to $100 range. So from that standpoint, we're looking really good on an inventory level. This is the SPR, so the Strategic Petroleum Reserve, which has been talked about a lot recently. So we've drawn roughly 70 million barrels, I believe, in the last year, 60 to 70 million barrels in the last year. So the SPR is supposed to be used for times of extreme stress and market dislocations, wars, hurricanes, etc. But the government seems to think that is just there to be used to manipulate the price, and you can do it for only so long, and then when this runs out, you will be in a very, very bad situation, especially if there is geopolitical tension or other weather events that require the SPR release. So can it help in the short term to reduce the price of gasoline? Absolutely. Is that a good strategy moving forward into the structural supply crisis? I don't think so, but who am I to say? Product storage, there's a couple of questions that came up as to why the products were building for the last couple of weeks, and this is your answer. They always build going into the end of the year. Demand is usually a little bit lower than the summer months, and some of this has to do with a taxation thing, that the refineries would like to process a lot of crude and build products. I don't understand the whole taxation thing fully, but the data shows that that's what they're doing for the past 5 years anyway. And I'm sure if you look at the data going further back, you'll see the same thing. So nothing really to worry about. We sit at storage levels that are lower again than the last 5 years considerably. So we're looking good on this front as well, and something to watch as we kind of go and monitor is the rate that the products are building higher than previous years, and if it's not, then it's really not something to be concerned about. They usually build this time of year. Moving into gasoline inventories, sitting below 5-year averages. This is kind of an older chart, but you see the same thing. Gasoline always builds this time of year. And even if we have builds in gasoline for the next month or so, nothing to be concerned about. And given the gasoline numbers, the demand numbers that are coming out of America, I don't think it's going to build at this rate either. So again, something I'm watching very closely on every EIA report and kind of following along. Distillates is the exact same story. So heavy diesel fuels and jet fuels and such, we're sitting below 5-year averages, and we continue to have record demand. Propane is the exact same story. So for people doing their winter barbecuing, you might be paying a little bit extra, but you know, the main story is that inventories are sitting very, very low, and that's with all the demand, all the supply that's come online in the last 6 months, all the DUCs that have been completed, all the workovers, the OPEC production coming back online. We still see inventory sitting below 5-year averages. So looking really good heading into winter and heading into the 2022 demand season. Global inventories continue to show the same thing. We had this big build in March to May of 2020, and then from then it's been a consistent decline, and the declines are getting bigger and bigger as we go. I don't have the latest data from Kairos, but you know, I think once this chart is updated, we will see the same trend declining, and we're right now kind of at early 2020 levels, late 2019 levels, and continue to decline from there. So, you know, if the general thesis is that supply is going to continue to falter and demand is going to continue to increase, well, our global supply demand is already looking really, really good from an investment perspective over the last 18 months. So that's to continue. Things are looking good. Saudi inventories, they've dropped by roughly 200 million barrels in the last 5 to 6 years. They sit at record lows. And, you know, if you kind of average this out, it's roughly, I want to say 150,000 barrels a day that they've been pumping out of their inventories for the last little bit. And it's not going to continue. They're not going to pull their inventories below certain levels. And you can already kind of see that where the line has stabilized. So that's oil that was coming into the market that is no longer coming into the market. So, you know, with each of these things that you add up over the global supply demand curve, things are looking really good from an inventory perspective. There really is not excess inventory that was built up due to COVID still there. It's all gone. And now we're pulling into where we were at the beginning of 2020. And we see this whole structural shift in that, because for the last 18 months, the inventory has really provided a buffer in terms of the oil price and not having it spike. So, you know, as we draw down these inventories, there is no more left. So it's going to be up to supply to come in, and can it come in? Well, I'll talk about it here as we go. The demand side looking really good. American gasoline is last week was the highest since mid-August, which is not something you hear very often. Usually the demand continues to slide into the new year. And we've seen 2 weeks now out of the last 3 that have been at August levels, when we have record gasoline consumption across the US with summer road trips and such. So looking pretty good on that front. The number of commercial flights continues to catch up to 2019 levels. And, you know, we see the 2019 curve was kind of going down into the December month, which is pretty typical. But we see that 2019 or 2021 continues to stabilize and even increase. So we are catching up to that. And I had a question last seminar on jet fuel demand and the impact on this new variant on jet fuel demand, and whether, you know, we're going to see again a big drop in that. So I kind of dove deeper into jet fuel and you know, are we going to see demand decrease, or is there a lot of upside risk? Because jet fuel demand is the one product that has not recovered to 2019 levels. It's still lagging behind by about, you know, I'm not going to really quote a number, but I want to say 1.5 to 2 million barrels a day roughly is what they say we're behind on jet fuel yet. So I was kind of curious because this graph seems to show that we're almost caught up. So where is the demand lagging? Well, the demand is lagging because a lot of the flights that are missing here are international flights, which are the big jet fuel usage flights. Domestic flight from LA to San Francisco uses barely any jet fuel compared to a flight from San Francisco to Tokyo or London or India or whatever. So even though the number of flights has recovered, our jet fuel demand still has a long ways to go upwards. And the deeper dive I did on this came to this conclusion that the upside risk on jet fuel is much higher than any impact that this new variant is going to have. And I'll explain that here. So if we look at China, the number of flights in China, we're still lagging 2020, we're still lagging 2019. So there's still a long ways here to go. We look at Indian flights, we see consistently rising. We see that the Delta variant had a pretty significant hit, but then since then we've just been chugging along upwards and upwards, catching up to these 2019 levels. We look at Australia and Canada. It's kind of the same story. We're significantly below 2019 levels, and we continue to increase. So the risk is to the upside. We have the potential for us to go upwards and upwards. And as far as going down, there's really not much to go on the downward phase. Like, things have changed a lot since March 2020. The whole human nature and the psyche of things has changed. People are not as willing to just shut down completely. So the base level of flights will continue. And we see that as people travel more and more, it's increasing, even in countries like Australia, which are known for their doomsday scenarios and such going on there. We look at Japan and Malaysia, it's the same story. It's increasing slowly, and we have a long ways to catch up. We look at South Africa. With all this talk about flights being banned from South Africa and such, the number of flights has not dropped. And this was a really interesting graph to me because there's all this panic about blocking countries and such, and nothing really has changed. The people just don't care anymore. Indonesia, we see the same thing, slowly going up and catching up to 2019 levels. So all the data is telling me that jet fuel demand is recovering. It's going upwards, and it has a long ways to go to catch up, given that a lot of these countries that I've shown here are international flight destinations, and they have a lot of business travel associated with them. So to me, I'm not concerned about jet fuel. It's going to keep rising, and it's going to be more and more demand coming on, as opposed to some sort of crisis causing flights to go down again, because the data just does not support that. We look at Germany and the UK, they're holding consistent. They usually have drops come November, December time, just seasonality. And this year, the drops are not as big. And again, a long ways to catch up. And Germany and the UK are travel hubs. They're places where flights from North America to Asia stop. So you have London, you have Munich, you have Berlin, Frankfurt, etc. They're big hubs for Lufthansa and British Airways and United. So as these international flights continue to increase, we will see jet fuel demand is going to just go crazy. Coming back to the same point is that these international flights use a lot more jet fuel than short haul domestic flights. So that being said, we look at travel destinations that are completely open. Mexico is above 2019 levels already. The Dominican Republic is above 2019 already and continues to rise. So the demand is there. For countries that are open, you will see increased jet fuel demand that can bypass even 2019 levels. So it just adds more and more fuel to the fire on the jet fuel situation. It's, we're still sitting at a position where we have nowhere to go but up, and we have a long ways up to go on jet fuel. Colombia, we see the same thing. Fiji just opened their borders on December 1st, and look at the increase. It is exponential as to the number of travelers that have come in. So, if we go back to the flights in to Malaysia, Indonesia, Japan, and such. What's going to happen when they open their borders fully to international travelers? This is what we're going to see. We're going to see a sudden, sharp increase in jet fuel demand. Especially to destinations like Bali and Southeast Asia, which are big travel centers. They're still completely closed off to the world. So once they open, it's going to be an extreme and sudden increase in jet fuel demand. And when is that going to come? Well, I don't think those countries are going to forego their 2022 travel season. So, whether it comes in early next year or maybe into the springtime, it is going to come, and it's going to be extra demand that the market maybe is not accounting for to happen all of a sudden, all at once. I hope that explains things on kind of what I'm seeing on jet fuel is up and up. I don't see any data that's showing a loss of flights from this new variant. It hasn't affected any country as far as I see, and it's just going up. So coming back from jet fuel, we go to gasoline demand. Indian gasoline demand is sitting above 2019 levels already. We see the same for any product you want to look at. I didn't show all the graphs here, but it's looking very, very strong. And this graph on the right here is a share of SUVs out of the total car sales, continues to go up. People are not really worried about gasoline miles per gallon too much. They're worried about safety. They're worried about going camping and being able to fit all their tents and their skis and their wagons and everything in the car or truck. They want more room. They want to be higher off the ground. They want to be able to drive in the snow and the rain, etc., much more safely. So this trend is across the world, is shifting. People don't want to drive sedans anymore. People don't want to drive small cars anymore. So, what does that mean for oil demand? Well, the same number of vehicles on the road are going to be consuming more and more gasoline. So, from that standpoint, it's looking good. Is this trend going to change anytime soon? I don't really see it yet. The whole chip shortage situation has affected pickup trucks and SUVs a little bit more than it has sedans. So, it could be a short-term blip, but I think overall the trend is the same. People who have sedans are looking to move into bigger and bigger vehicles, and the extra 10 to 20% cost in gasoline does not seem to be affecting that decision making on their part. So going into Chinese oil demand, one of the most difficult numbers to find, being that it's becoming a bigger and bigger player in the whole oil supply demand globally. The data is still not good. It's so hard to find data on this, but so Chinese crude oil imports were at their lowest in almost 3 years in September, and then we went up roughly 11% for November data. So it's rising. They cannot deplete their inventories forever. They cannot sit around and have their economy suffer forever. So, it's going to increase. It's going to go back up to these rates that we saw earlier. The imports of oil products rose 20%. So it's all rising. These countries need energy to feed their GDP growth, to feed their growing population, their growing middle class, their growing energy consumption. And they can't sit around here waiting for oil to show up and trying to time the market. So I expect this to continue to increase. There's a little bit of a talk about a Chinese economy slowdown. I don't have any data to support that or to go the other way on that. So something I'm watching for with this oil demand and supply information that's out there. This table on the right shows how they were pulling over 1 million barrels a day from their inventory starting roughly in September. And it can't continue forever. You have to refill these tanks. You have to have oil that's not non-inventory oil, because it's not going to be there forever. And we see here, China Sinopec plans to raise diesel supplies by nearly 50% month over month. So, it's all pointing to higher demand and higher consumption of products. So from that standpoint, it's looking good. Do I trust all this data completely? Maybe not. We don't have the most transparent data globally compared to what America provides, but it's all out there, and we make our best educated guesses based on the data that we do get. Chinese electricity consumption, up and up. It does not stop. You can talk all you want about switching to solar and wind and such. Those types of industries cannot give you this sort of electricity consumption increase year over year. It has to be natural gas and oil and maybe nuclear for the countries that have that can provide this, with a little bit of solar and wind on the side. So it's just a steady curve up. We see no stopping in this. It's a straight line up pretty much. There's no curve to it at all so far. This is a graph that I talked about last time, one that was very interesting to me. It comes out of the BP Statistical Review and the UN. It shows the energy demand / consumption per person compared to the Human Development Index. So the countries at the bottom of this are kind of countries that are still running on bamboo huts and walking everywhere, etc. Then you have, you slowly get electricity, you get horses, you get lumber processing, etc. Then you go into motorcycles and cars, etc., etc. So we see America is here at the top. We see China starting to go to the right here. And the most interesting point I want to make about this graph is that the curve is exponential. When you go from using a motorcycle that gives you 80 miles per gallon to now having 3 vehicles in the house and 5 refrigerators and 6 barbecues, the energy consumption per person increases a lot. It increases exponentially. And there's a lot of countries here that want what America has, and they are going to get it because the population wants it, and it's up to the governments to provide it. So as these people are lifted out of poverty, as they go into the middle class, as they move to urban centers, the demand per person across the world is going to increase at this exponential rate. And it's not going to be solar and wind that provide this. It's going to be coal, natural gas, and oil for the majority of it. So the demand is coming, and it's going to come fast. So if we look at this box in particular, this box contains about 4.5 billion people out of the 5.5 that this rectangular box contains. So the majority of the people are already past the lowest levels of poverty. They have the basic luxuries, the basic necessities of life, and now they want luxuries. They want bigger vehicles. They want more electricity. They want TVs. They want cell phones, etc. So as the number of people in this box shifts to the right, the exponential usage of energy is just going to compound the worldwide demand that we see across the world. And I saw a tweet on this this morning or yesterday that whoever thinks that global demand for oil and coal and gas has peaked is absolutely crazy, because it really hasn't. People are going to go to the cheapest source of energy, and if that's coal, they're going to use coal. If that's oil, they're going to use oil. And that's just the reality of things. As much as we like to sit around and talk about ESG and stuff, the reality is that a lot of people just don't care. They're here because they want the luxuries. They want to live a higher quality of life, and they are going to get it. So this is kind of a near graph, and what it shows is that when China's total oil consumption was at this point, this represented by this black dot, we saw it started to increase at an even higher rate, because this is kind of an inflection point where when you look at the oil usage to the population, this is when people really start to use more and more energy. And if you look to the right, this is exactly where India is right now. And India and China's population, roughly we can say is equal. And if you go back 20 years and you look at how much Chinese oil demand has increased, we're looking at roughly 500,000 barrels a day that it has increased. So now that India is at this level, that's what's going to happen there. So, is that being modeled by every one of these agencies that seem to use the same demand increase for the last 10 years? Maybe, maybe not. But the reality of it is that there's more and more countries that are reaching this point of inflection where the energy demand just rises up exponentially instead of going at this kind of linear curve for the past few years. And this graph on the right was one that's been floating around here the last couple of days. So the black bar on the right is the average annual electricity consumed by one refrigerator in America. And these green bars represent these countries and the annual electricity consumed by a person for the whole year. And these 6 bars here represent 500 million people who are currently using much less energy than a single refrigerator in America. And it's just shocking, the magnitude that's different. And these countries in the next 5, 10, 15, 20 years are going to want the same luxuries. And their demand is just going to skyrocket. It's going to be just amazing to see how that's going to happen. And for all the talk, again, I hate to talk about the same topic, but these renewable sources are just not increasing at the level that we require to take current demand increase, let alone this pent-up demand that's sitting here that's going to come out of nowhere in the next 10 to 15 to 20 years. So, when the reality of this sets in, when you look at human nature and the realities of some of these people, and people are still talking about peak energy and peak oil, it just doesn't make any sense how you can come to that conclusion given these sorts of data points that are out there to see. So world demand growth, US, China, India, Thailand, some of the big population centers in the world, we see the same thing. The oil consumption continues to grow and the rates are increasing. So even in America, where you would say is probably the best of the best, we have the best access to energy, it still continues to increase more and more and more year after year. So these countries are going to grow at an even higher rate. So, my whole thesis on this upcoming oil supply demand has been that demand is going to surprise to the upside by a lot more than people think. And all this data points that I'm seeing have given me that conclusion, is that not only do you have increased demand year over year over year, you also have this pent up demand from the last couple of years from people sitting around who haven't seen their parents, for a couple of years. They haven't seen their grandparents. They haven't seen their cousins. They haven't had their weddings. They haven't had their parties or whatever you want to do. And people are going to make up for that time. They're not just going to say, oh yeah, the last 2 years were fine, we'll just move on and continue our usual demand. No, they're going to make up for that time. They're going to be going out and having drinks and going traveling, etc. And the demand in 2022 and 2023 are going to be absolutely insane. And whether that actually happens, we will yet to see. But that's my thesis, that's my opinion. And that's why I'm very, very happy with holding these stocks and equities and options and such through this, because from what I'm seeing, it's looking very, very good going into the next couple of years. Are there any questions so far? Anything? Feel free to interrupt me anytime if there's anything you want me to explain further or look into. So we'll continue on. This is the population versus the vehicle growth that we saw. I believe this graph is from America. So when you look at the last 70 years, you look from 1950s, when vehicles really weren't a thing, to 2017 now, the population has only increased 2x. The number of households has gone up 3x because more people are living with less people in the house. People are living in smaller families. The number of drivers has gone up 3.5x. The number of vehicles has gone up more than 6 times, and the total vehicle miles traveled has gone up 7 times. So if we take the same graph and we put it to China and India and Malaysia and the Philippines, etc., this graph is going to be compressed. It's not going to take 70 years because vehicles are already kind of very easily accessible today. So this whole graph of 70 years might take 20 years, it might take 25, 15, depending on the supply that's out there. And if the number of vehicles goes up 6 times, what's happening to gasoline demand? It's going through the roof. And that's just how things are. And maybe you can argue as to how compressed this is really going to be, but the reality of it is that people are going to drive, people are going to buy vehicles, and if you can look at that going forward, and you're invested in oil companies, it's looking really good from a demand perspective. Coal demand, all this talk about peak coal and coal is dead, and we're gonna, almost all of Europe has basically destroyed their coal demand and shot themselves in the foot, as we see right now with their winter electricity pricing. And guess what? Worldwide coal demand has not really dropped. It's still at the 2010 peak. And as energy becomes more and more scarce, is this going to increase and have a new fresh high? Potentially. Coal demand, I'm not saying it's the energy that we should use, but it's the energy that people do use, given that it can be the cheapest source of energy in some of these developing countries. And they're not just going to shut down today and start paying 3 times or 4 times the price for the substitute that's out there. Moving on to the supply side of things. So, demand is going to increase. We know that. Is the worldwide oil supply balance good enough that we can make up for that demand? Well, the data shows that American oil production is roughly 1.5 million barrels less than early 2020. It's not really increasing. 2021 so far, we've had roughly 500,000 to 600,000 barrels a day, you can say, from early 2021 increase. Is that enough to offset global demand? Not really. The rig count slowly grinds up. It's nowhere close to what we were in early 2020. We had about 700 oil rigs keeping 13 million barrels a day flat. We're about 475 right now. We need to add more rigs. The reason production has not dropped so substantially at this low rig count is because of DUC. So drilled but uncompleted wells. There's a huge stack of these wells that got accumulated in early 2020. And companies, instead of drilling new wells, are just completing them. They're completing the wells that have already been drilled and sitting there. We see for the last 6 years, these two curves went hand in hand, pretty much bang on, until the last 18 months or so. And we're completing way more wells than we drilled. And what's the problem with this? It's the same problem as inventory. It only lasts so long. So there's roughly 5 to 6 months of good DUCs left for companies to eat away at. And after that, they have to increase the rig count to make up for it. And are there enough rigs out there? We just heard Peter talk about the rigs and not having enough labor and steel and such. Is there enough steel out there? Is there enough labor out there? And I just read an article a couple of days ago about frac sand now is becoming a problem. There's not enough sand out there near the Permian Basin. So the supply chain problems, along with government regulatory headwinds, you can say, are going to have a huge impact on whether the rigs are actually going to come back or are they not. And that will be kind of a defining moment. So early April, early May, when the DUC count starts to get really, really thinned out, if we don't see an immediate response in the rigs, that is looking bad for American oil production. And whether the call on them in 2022 to supply the world's growing demand, are they going to be able to meet it? We don't know yet, but we'll find out. And all the data we're seeing on the supply chain standpoint tells me that we don't really have enough out there to add another 150 or 250 rigs by Q2 next year. But that's just my opinion. and we'll kind of see how that plays out going forward. This is the drilled and uncompleted wells. It's just a straight line down. Companies are preferring to use this method instead of spending money drilling and completing wells. They're only completing wells, which adds to the economics today. However, again, once this starts to run out, we're in pretty bad shape. And we see roughly 5,500 DUCs available today. However, a lot of these DUCs are uneconomic. They're wells that were drilled more than 2, 3, 4 years ago. They're wells where they never found any oil. They're wells where there was a problem in the drilling and the well is basically unproducible. So there's really only roughly 1,500 to 2,000 DUCs left. And we're going down roughly 200 a month. So again, we end up at the same 5 to 6 month number that we have left if we continue at the same rate. And this is kind of a story that is very, very exciting to watch. It's one that has been discussed extensively at length, and we'll kind of see how it plays out. This is the Permian Basin in America, the one that really has been the story in this shale revolution. And the curve on the right shows the decline rates of the wells / the production of the wells that were drilled by a certain year. So for example, this dark green is all the wells that were drilled in 2017, 18, 19, 2021. We see that we're struggling to maintain the production in the Permian where we are right now. Even with the DUC count being absolutely used up and rigs rising, we still don't see production really increasing. And if you look at the slope of these lines, it's just unbelievable. Of all the production that was from all the wells drilled up to January 1, 2020, we take the production today, it's down 60% in less than 2 years. Does that sound like wells and supply that you want to rely on moving forward? It's really not a good look. It's one that, yeah, you can increase production from zero very, very fast. But once you're up to this 4 million barrels a day range, you're just constantly trying to keep it on pace to mitigate these declines, let alone add more production. And there's talks about the wells are more efficient than before and the rigs are more efficient. So on this left graph, we have the production per well. However, it's normalized for the length of the horizontal. So if you keep drilling bigger and bigger horizontals and you keep jamming more frac stages and more sand in there, you're going to get more production, but it's going to cost you a lot more. So if we normalize it for this increase in horizontal length, the productivity of the well has been pretty much flatlined since 2016, which is this light green line right here. And in fact, these wells that they're drilling with more and more horizontals and less well spacing, they're not performing as well going into year 2 and 3 and 4. They're actually straying from the pack and starting to show bigger and bigger declines just because of the way the wells are. The more production you bring out of these wells right off the bat, the more you affect your ultimate oil recovery out of these wells. You can have one or the other. You can't have wells that produce way more and then keep producing the same oil for longer and longer. You're going to have bigger and bigger declines, and we see that. These 2019 wells have really started to stray from this 2016 and 27 line, and that is not looking good going into the future for shale. And the companies now are drilling even longer and longer horizontals. So it's one that, yeah, you can increase production right off the bat and show these huge numbers. We drilled 2,000 BOE a day wells, etc. Well, you look at the long term, they don't end up being as economic, or maybe economic is not the right term, but as productive as some of these wells with better spacing and more optimized horizontal length. Is there any questions on this? This is kind of a new one that I've been focusing on recently, and trying to find out if shale can really be the call in 2022. No. Okay, well, we'll continue on. So the rig counts, America's rig counts, the majors are flat. The large cap public companies are flat. The small to mid caps are flat. So who's increasing production and rigs? It's the private companies. And what are they increasing production for? Well, a lot of the talk that's been going on is that some of them are just taking on rigs so that they can sell. They can increase their production in 6 months and jack it up, and then before this huge decline comes in, they want to try and find somebody stupid enough to buy them based on this huge production that's going to be half of what it is in 6 to 9 months. So putting lipstick on the pig, as they say. And is that going to keep continuing? Well, we don't know yet. The number of rigs by private companies is already at January 2020 levels. Do they have the money and the backing of the banks and the private equity firms to keep jamming capital into the ground? That depends on your own personal view on it. Me, I don't really see it. It's got to stop at some point. And if we look at this graph on the right, there's not that many new companies out there focused on US upstream shale production. We went from 133 in 2017 to 9 in 2020. And the banks have had enough, the investors have had enough, the private equity has had enough. They said enough of these zombie wells that don't produce anywhere near what you told us they would produce. And what's with this decline? You predicted that this would be the ultimate recovery. Well, it's nowhere close to that. So the money just isn't there. This is just companies that are established producers. So companies in the Permian would be like Mewbourne Oil and Endeavor, which are established family-run private companies that have been operating for the last 50, 60 years. I'm not sure how long exactly, but they have the backing of the family, of the private shareholders. And the biggest thing is they pretty much got the land for free compared to some of these companies, these private equity companies that are coming in now and buying land at $20,000, $30,000, $40,000 an acre. Some of these privates that are increasing their rig count got the land and the acreage for very, very cheap. And they have mineral rights and they have other extra bonuses that allow them to increase these rig counts. But any new company that's out there, has to be very, very careful as to what they're doing, because the shale oil has proven that they do not generate free cash flow unless you have very high oil pricing, or you got the land for much cheaper than market rate. So this will be an interesting one to watch. I personally, my view is that this is pretty close to being done. You'll see rig increases actually coming from the public companies now. As their DUC counts kind of become exhausted, they'll be the ones who might increase a little bit. But the private companies, I don't think have the room to run or the money supporting them to really go much, much, much higher than this. Coming back to American supply. So America became a net exporter of crude oil and petroleum products in early 2020. They were exporting roughly 1 to 1.5 million barrels a day. Looking at the last 6 months, we are now back to being an importer. They're importing roughly 500,000 to 1 million barrels a day. So what does that tell you? That tells you that on a global supply demand, overall look, America is now pulling in 2 to 3 million, 2 to 2.5 million barrels a day of crude oil and products that was previously was available on the open market for countries like China and India and Africa and Europe, etc. So this oil is no longer there. It's being consumed internally by America. So on a global market, the data is not as transparent compared to what America puts out. But based on this trend, we can just see that that's roughly 750 million barrels a year that's no longer available on the market. and has to be found from other sources. So, the demand is going up and the supply is shrinking. We can come up to our own thesis for what's going to happen in 2022 and 2023. Oil investment rates. This graph on the left shows the oil reinvestment rate. So the kind of this light blue / gray line shows you that companies were investing way more money than they were cash flowing for the last almost 10 years. And in the last 2 years, it's just fallen off a cliff. It's gone to less than half of their cash flow. They're giving out more money in dividends. They're paying back their debt, deleveraging. They're spending more on share buybacks. And they're just not putting dollars back into the ground. So, and this curve has continued its downward fall, even with oil prices rising and more of this, drill baby drill mentality that might be out there. So from a capital allocation standpoint, so far it's looking good. There's not that many companies that are out there saying, hey, we got $80 oil, let's ramp up production and start going crazy again. It's just not happening, and it's just not happening to the same extent at all that it was back in 2014 and even 2018 timeframe. So that's looking really good, and all this money is being given back to shareholders. It's dividends, it's share buybacks, it's special dividends, it's accretive acquisitions, you can say, if you believe that, and it's all money that's coming back instead of going into the ground. And this graph on the right shows this more on a global basis. The Capex has just dropped off. After 2015, we are not investing the amount of money we need to keep up with global oil demand and the growth. And looking into 2025, the prediction by Rystad Energy is that it's not going to increase. Companies have had enough with getting, not making money, A, B, getting hounded by investors, C, seeing their share prices tank, and then D, not getting any appreciation for what they've done over the last few years to improve the general human's quality of life. They just get annihilated in the media from all the people that family and friends who if you tell them you work in the oil and gas industry, just go on this rants and venting about killing the environment and such. So, companies said, hey, we'll make our money, we'll not invest as much, and we'll keep prices a little bit higher, and we'll show the people that they really need us as we go into the future. To support their standard of living, you need oil and gas moving forward. So coming back to more of a global look on oil supply. For any oil that's conventional, so non-shale, non-fracked oil, the oil that was here for us from the 1900s all the way till even recent times, the conventional vertical drilling, the fields, the huge fields that OPEC has, Saudi Arabia, Kuwait, etc. They all follow a similar pattern called a Hubbard linearization. Once you produce about half your recoverable reserves, so the amount of oil you can physically produce economically, once you go half of that, your entire field production goes into a terminal decline. And you can extend out the tail a bit using techniques like EOR, water flooding, infill drilling, CO2 floods and such. However, that doesn't happen until you've gone well below your peak oil production. So this is US conventional production. We see the same thing. When they produce about half the reserves, production just fell off a cliff and just tanked. And recently they've been able to kind of keep it steady at about 3 million barrels a day. But the reality is they cannot maintain these rates at the top forever. So we look at Ghawar, which is Saudi Arabia's biggest oil field. It's the world's biggest oil field. Just a massive discovery. And we're roughly right now at the point where we've recovered half our reserves, and production is 5 million barrels a day was what they were telling us. When Saudi Arabia or Aramco IPO'd in 2019, they told us production was 3.8 million barrels a day. So if we follow this curve at 3.8 roughly right here, bring it across, we get roughly 2016. So it's following the trend. And the most recent number that I heard was 3.2 million barrels a day is what it's producing today. So if we take 3.2 and bring it across, we get 2021. So this field, the world's biggest oil field, producing almost 5% of the world's supply just 10 years ago, is now producing about 3% of the world's supply. Incredible decline rates. And it's going to continue to go down until it reaches this point where you can kind of extend it and keep it going. But until then, until about 2026, 2027, we will see continual decline from this field. You might be saying, well, this is just one field. Well, let's look at all the fields in Saudi Arabia. It's the exact same story. They all peaked roughly 40 years ago, and it kind of is exactly when Gawar peaked, and they maintained that production for roughly 30 years, and then it's a decline since then. And we look at Kuwait on the right here, it's the exact same story. And if you look at OPEC plus, it is the exact same across OPEC plus. And Kuwait, there was recently an article that came out that they can't even produce 2.5 million barrels a day in 2021 so far. So the declines are actually bigger than even sometimes this curve shows, as you have this huge decline that comes out of nowhere, and the producer is not ready to supplant it with increased infill drilling and other techniques to try and maintain this production. So, we look at Saudi Arabian rigs. They were maintaining production at this low rig count. Then they went higher and higher and higher to maintain their 10 million, 11 million barrels a day of production. And now the rigs are not anywhere near enough to maintain that. So we have a double whammy. We have this huge decline in these conventional fields with an international rig count that is much lower than it was from 2013 to 2019. And we have this double whammy effect on production and OPEC spare capacity and worldwide spare capacity, if you really want to talk about it that way. And going back to this conventional field, this is a field in Mexico, CNRL. We have roughly 2 million barrels a day production in 2003. By 2015, it was down to 400,000. And the last I heard, this field is only producing 50,000 barrels a day. So it's down roughly 98% in less than 20 years. That is not a good sign for the global oil supply. And we look at worldwide, the exact same thing is happening in every single conventional field across the world. So, you have German fields and such, which are totally dead. You have India, Egypt, Malaysia, Argentina, Colombia, Ecuador, the UK, Australia. It's all the same story. We are in this terminal decline phase, which is very hard to stop. In fact, it's just about impossible. And for a few years, we thought, hey, we'll just have these unconventional fracked wells that'll just make up for it. Well, shale is not what it was touted to be, not even close. And with the declines that we have in these unconventional wells, they cannot be the producer that's going to sustain, really decent production. You have to jam so much money just to sustain those kinds of productions that the worldwide oil supply is really not in a good position, especially as these declines continue to go. Like this data is only till 2010, but it's going to continue to decline, and we really have not invested enough money in exploration and new development to arrest the declines here. And when the world comes to the reality of this and the understanding of this, it's going to be an absolute shock, because people think that oil is just out there and there's massive pools all over the world, and we'll just keep using the oil we have. Well, it's not there. It really is not there. So, if you understand and you're happy with this thesis on supply and then the demand thesis that I discussed earlier, there is no reason to be afraid of owning oil stocks into the future, because the whole ESG movement, etc., it cannot stop the reality of math and physics and science and human nature. So, yeah, that's just my understanding of that. South American oil production. So, we do have fields across the world that are producing higher than they were 5 years ago. Brazil, offshore Brazil being one of them, offshore Guyana being one of them. We have some new developments in Asia. We have some new developments in the oil sands that have come online recently, etc. But, look at the rate. They're growing at roughly 150,000 barrels a day per year. That is nowhere close to enough compared to the declines in conventional production, along with the growing demand that increases another 1 to 1.5 to 2 million barrels per year. So, all this talk about, hey, offshore Brazil and Guyana and such are gonna supplant this, etc. Brazil is roughly 150,000 barrels a day per year extra. Guyana is roughly 200,000 with ExxonMobil and Hess doing their consortium. So, these are very, very small increases. One of the members who attended this seminar 2 weeks ago sent me an article on this new development in offshore Russia somewhere, and they say they want to be at 2 million barrels a day by 2031. It's the same number. That's only 200,000 barrels a day supply increase year over year, and it's just not enough. And that's a $170 billion project, which no company other than these IOCs that are owned by Russia and such want to spend that kind of money. They don't have that kind of money. ExxonMobil, Chevron, Total, BP, they're not out there doing these $50 billion and $100 billion projects. There just is no appetite for it. So, it all comes down to the same thesis, is that if you agree with this supply demand kind of thesis going forward, the world is going to be in a world of hurt. People are going to have to pay a lot more for energy than they've gotten used to. They've gotten used to cheap energy and buying whatever they want, and leaving the lights on and buying all this stuff. Well, it's going to get expensive, and that's just the reality of how it is.
Hi, Shabam. Do you mind if I pull some data from Brazil?
Yeah, for sure. Yeah.
I just actually have a write-up, and I've been reading over the annual reports for Petrobras, right? So they're state-owned oil company that produces most of their oil. Petrobras, which represents most of the oil production in Brazil, although they have increased production, their actual proven reserves have dropped to 7.8 years as of this year.
So, what does that tell you? That they're touting all these numbers, and unless they have more discoveries, they cannot maintain these rates anyway for the next 10, 15 years. So again, it comes down to the same problem, is that you can increase production all you want, but unless you have the reserves and the production capacity and the refineries and the pipelines, the transportation to really go along with this increase in production, it's very hard to sustain. So yeah, thanks for sharing that thought. I think offshore worldwide is going to be one of the biggest sources of increased oil production. There's a paper out there, a very, very good paper out there that I'm looking to get access to, which goes through the entire supply that's out there in offshore fields. And once I have that, I can kind of provide more color on supply going forward. But that being said, some of these countries that they're increasing production in are countries where you don't know what the geopolitical climate is. You don't know what's going to happen there when people see all this money rolling in. It's unsure, and even if it's 100% sure, the production increase is just not enough to go with the increased demand and the decline. So looking very, very good. Bank and analyst comments. So this is kind of the same that I had pre Omicron variant. Goldman is seeing upside risk to $9 a barrel Brent. RBC's Michael Tran is talking about this multi-year structurally strong cycle, because until you get investment in these huge production capacity, new supply like oil sands and offshore and such, the oil price is going to continue staying high. And until companies are happy that, hey, we can invest in something right now and 3 years later the market is not going to crash, they're not going to invest. So that's where he's talking about this multi-year structurally strong cycle. Bank of America is talking about $120 a barrel in 2022. As I talked about, this booming air travel with international flights returning earlier here, that's really the catalyst. People look at flights and say, oh, we're almost at the same number of flights as we were 2 years ago. Well, it doesn't show you the full story that these international flights are coming, and they will just add a couple people here, and they will continue to have these huge jet fuel demands coming back in the first half of 2022. Vital, which is the world's biggest oil trader, is talking about market supply demand is going to be reasonably tight, the price spikes and such. So, for people who are interested in what the analysts have to say and the banks, I kind of got shafted on for using these in a Twitter space last week. But you know what? People talk their book, yeah. But if you've been following some of these people, like especially RBC's Michael Tran, he's not talking his book. He's talking what's actually out there, and he's been bang on for the last 18 months exactly what's happening. So, yeah, there's some banks that like to have positions and then they talk in order to make money on those. But at the end of the day, there is still a certain element of truth to these, especially people who are putting their own name behind it. People don't like to be wrong all the time. So there is some reality to what's out there. The party is just getting started. So, this cycle that we're in right now, we haven't seen the gains of the previous cycles, not even close. We're still a long ways to go up. And with the supply demand looking how it is, this cycle could be even higher because, we're running out of inventories. We're running out of DUC wells. A lot of wells in America that were shut down for the last 5-6 years have already come online because, guys that had wells producing 5 or 10 barrels a day saw $80 oil and they said, hey, let's fire up and let's produce some oil. So, a lot of these sources of extra oil sitting around has already been tapped into, or it's currently being tapped into. And a time is going to come. Maybe it's mid next year, maybe it's late next year, when there literally, for the first time in the history of oil, will not be a barrel available for you to buy. And that's really going to be the big reality that's going to hit people in the face. People who don't look at data and they go around protesting random things that just because their friend is there doing stuff and they don't want to look into the actual science and the reality of things. It's going to hit them like a brick in the face, and the price is going to spike. We're going to have a spike that maybe we've never seen before on this reality, when the world realizes, hey, we are heading to this huge supply demand problem, and you can't stop demand, and supply is declining. We don't have the oil to feed the world's growing need. This graph on the right is talking about free cash flow. So given that companies are not spending as much money putting it back in the ground and such, they're distributing more money. The free cash flow that we saw in Q3 2021 was higher than we saw with oil at $100 plus in 2014. So a lot of this money is going back to shareholders. A lot of this money is being used to deleverage, have better balance sheets, and it just looks good going forward. They have lower operating costs. Companies have really trimmed down and are looking good. Free cash flow machines going forward. This is the oil producer share prices compared to the broader market. So we see that WTI has risen a lot since early 2020, but the share prices really have not responded. And you know, people who've been invested in these equities for the last 18 months, I think will share this concern that, you know, hey, oil price has gone from negative 37 to positive 85, and the stocks really don't reflect that. Well, that is an opportunity. This curve has always been bang on, and in around 2017, it kind of went on its own path, but it is going to come back when the world realizes that ESG, you know, all the time on everything is not the answer. When the world realizes that people are not willing to lower their quality of life in order to lower the world temperature, you know, and such, and that's human nature. And when people realize that, and when people see this whole supply demand crunch that's upcoming, you don't need a huge movement in WTI for the stocks to increase 2, 3, 4, 5x and catch up to this historical norm that's been the case for the last 20 years. And I'll kind of end it on that, given that, you know, that's been a question I've been asked a lot, in that, what are WTI prices and what are the stocks reflecting? Well, there's a long ways up to go, and it will come. The day will come when the world realizes this, and when, you know, people will have no choice but to invest in these equities in order to get more supply and have them capital allocate more money into meeting the world's growing demand. So that's kind of the end of the macro outlook section. If there's any questions or comments, anyone has anything to add, feel free right now. I'll give everyone a couple minutes to open up the Enerplus Q3 report and the corporate presentation along with the Excel file. If you want to follow along and put in numbers yourself, they are on the website. It's at the bottom of the homepage. You can download the Excel file. And yeah, if anyone has any comments, feel free to add, and then we'll get started on the valuation section in a couple of minutes here.
Your macro outlook, Shabam, keeps getting more powerful. Well done, Shabam. Well done.
I'm just curious about the XLE and the S&P, because this is a thought. I was watching this is a couple of years ago. I was watching this Real Vision interview with Russell Clark, and he was trying to explain how the big thing in the oil market in the previous run, especially with shale, is all this investable capital into energy has flowed directly into the US. And now when shale is reversing, to my understanding, it's actually very, very bullish for the energy industry outside the US. Most likely the two biggest investable areas I think he was talking about was Russia and Canada.
Yeah, so you know, that's totally right. Like the S&P, I guess, slash XLE and such are just being used for a comparison to what's happened. But I bet if you compare the same graph to the Canadian sector, you will see the exact same thing. I don't follow the Russian sector, so I don't know. But you know, it's the exact same story. It's the share prices are lagging, given that there's not enough people that want to invest in oil equities. The people don't want to tell others. They don't want to show on their fund holdings that they're invested in dirty oil, etc. And once that kind of goes away, people start to realize the potential that's there. It's going to be a sharp increase. And you know, I think the Canadian sector, for a variety of reasons that I haven't discussed here, is the place to be compared to the American sector. Like, there's still companies you can find in the American sector that are maybe have huge potential, but my focus has always been Canada. So I don't know if someone has any insight on American companies more that wants to share, but I will say that my whole investment is in Canada for kind of the same reason.
Yeah, I kind of agree too. I just think that because most all the U.S. investment in oil has burned so many investors, I just think that the capital cycle may be ex-US for going forward in the new upcycle.
Yeah, certainly, and that's we can kind of already see that with even some of the U.S. majors are moving capital away from America, and then the private equity firms are not funding anyone new. So you know, we're already seeing that, and you know, maybe that continues into the future, and kind of is the beginning of the death of shale. You know, the end of shale will be a combination of all these factors coming together all at once. Especially once the DUC count runs out and people look at new wells and they're not really economic, you know, down to the numbers that they kept pretending they were for the last 5 or 6 years. So yeah, thanks for sharing that. Great point. Okay, so we'll get started on Enerplus, the valuation. So I'll say that from the last seminar, there was a couple of mistakes in there that I think were pretty glaring, and it's pretty embarrassing that I missed these. But the one thing is that I was taking dividends into account as a part of free cash flow, or sorry, not as a part of free cash flow, whereas they are. So when a company reports free cash flow, that is actually pre-dividend, free cash flow. So I've adjusted the calculations in the new spreadsheet to reflect that. And the other thing was that on these valuations at higher prices, it did not take into account the exchange rate from the US dollar, which is what this oil price is represented in, to Canadian dollars. So that did make a little bit of an impact. The newest spreadsheet is now uploaded on the website. So if you want to download the newest one and follow along, that would be good. And yeah, everything else is kind of the same for now. I'm still working on separating the liquids into a heavy oil, light oil, and an NGL. You know, just for more accuracy on that, given that NGLs, light oil, and heavy oil trade at completely different prices. And I'm still working on some hedging stuff and kind of having that better represented in terms of 2022 and then 2023 being kind of separated there. So yeah, but we'll get started on. Yeah.
Hi, Shubham. I have a quick question.
Yeah, go ahead.
The spreadsheet that you sent out on Thursday, does that have the updates, or
Yes.
is it the one on the website we need to use?
Yes, so the one that was sent out on the email also has the updates on it already.
Okay, thank you.
Yeah, you betcha. So yeah, we'll just put the company name in, Enerplus, at the top just for ease. So we'll go into the third quarter report. It's kind of what you're looking for Enerplus. You know, the first number we need is this number, the average daily production in BOEs per day. So 123,454. So we'll pop that in the first box here. And there's an explanation for all these boxes on the right-hand side here. If you maximize the sheet, you'll be able to see it, and kind of when you're running these calculations on your own time, if you are, it'll kind of alleviate some of the questions. So the number of oil percentage we need is right here, 64%. So we'll pop that in there, 64%. We need the number of shares outstanding. So I use basic shares outstanding, especially if they're very close to the number of diluted shares outstanding. The reasoning for this is that it really doesn't make much of a difference. There are smaller caps where you want to use diluted shares outstanding when the difference between basic and diluted is big. However, there are a lot of complications around that, given that a lot of diluted shares actually, you know, might be warrants or options where the company will actually get money from these shares, so or from this dilution. It's not a free dilution per se, but for the sake of Enerplus, I'm going to use this basic share count. So about 256 million shares. You know, throw that in there. The share price on Friday, 1366, I believe. So that gives you the market cap. The market cap is the total value of the company's shares. So just the shares are valued at roughly $3.5 billion. The next thing we need is the current debt that the company has. So that's right here again, first page. And I love companies that have the main information on the first page instead of jamming it into paragraphs and really making it complicated to understand stuff. So total debt net of cash is roughly, you know, 1.05 billion. So 1047. So we'll put that in there. And all these numbers are in millions. So when you're running these calculations, you want to put them in millions. The debt capacity of Enerplus is in their corporate presentation. So if you go to their corporate presentation and you go into page number 9, you see here, they show you a bar of liquidity. So the liquidity is the amount of capital or the amount of debt that they have available, but they currently have not taken on. So they have roughly, you know, 774 US. So let's say $1 billion Canadian in liquidity. So their debt capacity becomes the current debt plus the debt that they haven't taken on. So 1,047 plus the 774 US, which is roughly $1 billion Canadian. So, you know, we get a 51% debt utilization percentage. So, you know, they're roughly 51%, you know, usage of their debt. So pretty good situation to be in. They have a lot of room in case of they want to do acquisitions or they want to, you know, oil price again has some kind of collapse for whatever reason, etc. So pretty good situation. Stay flat capital. So I'm going to use 2022 numbers because there has been a lot of inflation that's come on over the last year. So Enerplus is saying that they're going to spend roughly $500 million next year to get a roughly, you know, 3 to 5% organic growth. So, you know, I'm just going to put 500 in there and keep in the back of my mind that that at this spending, they're growing roughly 3 to 5%. So, you know, if you want to guess, okay, how much do they need to stay flat? You can do all kinds of calculations. You can put it in there. The point is that this number does not get used in the calculation. It's just for knowledge kind of thing to compare different companies. So, you know, try to be as accurate as you can be, but don't spend all day long trying to get this number either. So the dividend is the next thing we need. So the quarterly dividend has increased to about 4 cents a share. Annualized, it becomes about 16.4 cents a share. So I'm going to put that in here. The one change that I've made in this is that previously on the previous seminars, I was putting in the last dividend. Now I'm putting in the future dividend because this number, since we made this change on the dividend into the free cash flow, is no longer taken into the free cash flow calculation. So you can look at it in a future perspective as well, or a past perspective. It doesn't change very much. So the next thing we need is the adjusted funds flow. So adjusted funds flow is the money that a company makes after they paid off every single expense that the company has, except new capital. So any capital for drilling wells, any small acquisitions that they made, you know, money for buying stuff, etc. So that tells you how much money did the company make after everything is taken into account. And that money is right here, adjusted funds flow. It's about 256 million. So we're going to throw that in there. Free cash flow is the money that the company made after all the capital costs that they put in. So any drilling of new wells, any new equipment, any new facilities that they fired up, anything that they bought new. So the free cash flow, the way that we calculate it is by you take your adjusted funds flow and you subtract your capital cost. So some companies have this number easily available, some of them don't. So we take adjusted funds flow 256 and we subtract capital spending 80, we get 176. And if we look further down in this same report, we see free cash flow 176. So, just a quick check you can do to make sure the numbers add up, especially if they don't show it right in this first paragraph. So we'll put 176 in there. And feel free to interrupt me if there's any questions. If you want me to slow down a bit or explain things a little bit more, I'm happy to do that for those following along, especially and putting their own numbers in. The hedging impact. So the hedging impact is important because this is the money that the company generated after hedging. However, we're in a time of very, very volatile oil pricing where the hedging can make money and lose money all over the place, but it's not permanent. It's only for a quarter or two or three. So we want to know how much money would the company make if they didn't hedge? What's the actual money that they're making without taking into account all these financial adjustments and such on this hedging? What's the actual true money that the company will make? We're seeing a lot of companies moving away from hedging also going into 2022. Like very little companies have actually hedged going into 2022 and 2023. So the whole mindset is shifting, and we want to know what's the true cash flow generation of this company. So the hedging usually will be, they call it many things, hedging, derivatives, risk contracts. So you really got to find the right number. And I'm going to look for it here because I don't know exactly where it is right now. So right here, under other expenses on page 23 of this report, we see that they lost $79 million on commodity derivative instruments. So they lost $79 million. So if they hadn't hedged, which is kind of the reality of Enerplus going forward, as these companies deleverage, they have less debt, they have not as many banks telling them what to do, they might not hedge going forward. So since this $79 million was a loss, we're going to put that in as a negative in here. And again, that's in the description here. It says put losses in negative. So, the actual free cash flow that the company made was $255 million. Share buyback, for those who are following share buybacks, you're interested in how much company or how many shares is the company repurchasing. You might want to put this in here. So I just search share repurchase and see what comes out. So there's nothing there. So we'll go right here. So the company repurchased 1.6 million shares in Q3 at this price for total consideration of this. So about $13 million. So I'm going to put 13 in there. And that's really all you need from the company's perspective so far. We need the last quarter's pricing. So the company generated this much cash flow, etc. But at what pricing? The pricing is not going to stay the same in the future. It might go up, it might go down. So we need to know this cash flow generation is a point in time at what WTI pricing. So usually there's a chart showing the benchmark pricing for the last few years, etc. So right here's the number we need. 70.56 was the average WTI price for Q3 2021. So I'm going to put that in there, and that's in US dollars. That's one of the only things in this whole chart that's going to be in US dollars, which is anything to do with WTI pricing. I'm also going to take the NYMEX price. So because a lot of Enerplus's gas, almost 100% is in the US, they sell it at NYMEX rates. And again, if it's about $4.01 is what the pricing was. So if we convert that into Canadian dollars, so we'll go last quarter NYMEX price. So $4.01 US is roughly 505 Canadian. I'm going to put that in there. On the gas side of things, don't worry about the units. Gigajoules, MMBTU, and MCF are almost exactly 1-to-1. And for the majority of oil companies, gas revenue is not a big deal for them anyway. And for us to spend all this time trying to convert this stuff is really not important. If you really want an in-depth, accurate calculation, yeah, feel free to put that in and adjust based on that. But for me, I'm just looking to do a quick calculation. I'm looking to compare 50 companies every month, 55 companies. I don't have time to be converting units when it's 0.99 to 1 anyway. So I just leave it in as is. Now we need the strip pricing. What is the WTI price looking 12 months into the future? For the next 12 months, what is the WTI pricing compared to this last quarter pricing? So the way we calculate that is we go into a website called the CME Group. And this is on the White Tundra website. If you go under dashboards and then links, all the links that I talk about today will be over there. This tells you what is oil selling at for every month for the next year, for the next 5 years, for the next 40 years. You can find out what is oil selling at. So to get the average strip pricing, we add up the next 12 months and we divide by 12. So that's exactly what I've done here. I've taken the next 12 months and I divided it by 12 to give me the average WTI price for the next 12 months is 70.3. It's a pretty basic calculation. You just, all the information is here. You take the next 12 months and you divide by 12 and you get your number. So 70.3 is the strip pricing. And this number moves. If you're running this spreadsheet on today versus a month from now, you will have to adjust this number for what the actual strip pricing is into the future. Other free cash flow sources, I'm going to put 0. I don't see anything that Enerplus can do. You know, they did do 2 acquisitions recently, but I think they're already synergized in there. I don't see any other free cash flow. If you do, you can put it in here and the calculation will take it into account. For Enerplus, they sell all their gas in the US. So it's about 100% NYMEX production. And what is the projected NYMEX price for the next 12 months? So we're doing the same thing that we did for oil on the gas side of things. I don't have this number in front of me. And actually, the website PSAC that used to have this number has crashed. So what I would do is go to CME Group, same thing. I would go here, go to the, you know, instead of looking at crude oil, we will search for gas and we find the same thing. We add up the next 12 months and we divide by 12. And what's happened here? So, you know, we'll go back here and, you know, I want to say when I did this calculation last time, the average gas price for the next 12 months was roughly $3.75 US. So, which is roughly 450, you know, 460 Canadian. You can put in whatever number you want in here and in the strip pricing. If you think oil is going to average $100 a barrel next year, you know, US, put $100 in here, put whatever you want in there. And the spreadsheet will calculate it for you. So on the chat, David did this calculation on Thursday, and he came up with 476 for him for Henry Hub. Yes. So I'm going to put 476 in here. I'll take his word on that. And we end up, the whole spreadsheet calculates everything for you. That's all you need to put in. So what do we have here? We have annualized last quarter free cash flow. What does that mean? That's telling you that if you take the free cash flow from last quarter and you annualize it, the company will make roughly $992 million in free cash flow next year. Awesome. Free cash flow yield, 22%. What this is telling you is that the company can, on an enterprise value basis, so market cap, the value of all its shares, plus debt gives you enterprise value, the total value of the company. Enerplus is generating 22% of that in free cash flow every year. So 22% of the entire value of the company, they could buy back shares, they could pay out dividends, they could pay back the debt, they could, make acquisitions, whatever. 22% of their current value is what they're generating in the next year. The way that I look at this, and this gives you the free cash flow yield across a variety of prices. So, 80, 90, 100, 110. And, between 40 and 50 is when it becomes negative. So that's when the company starts losing money and has no money to give out. It has no money to support its dividend and share buyback. So, somewhere between 40 and 50, roughly. And the way that I look at these companies, the way that I value these companies is I don't need the company to generate 22% free cash flow. I want them to generate 12.5. And 12.5 being chosen because it's a number that's widely accepted across the oil and gas industry. It's not something that everyone uses, but it's a number that a lot of people like. 12.5 tells you that this company can buy back all its shares and pay back all its debt in 8 years. If it generates 12.5% of the company every year in 8 years, that adds up to 100%, and they will be fully privatized and fully debt-free in 8 years. There's discussion on discount rates and NPVs and such. To me, it's not important because every company is in the exact same situation. They're all subject to inflation. They're all subject to bank interest rates. They're all subject to the same global economic problems. So there's really no reason to take it into account for the sake of this simplistic calculation slash valuation exercise. So if I want a 12.5% return, what I would do is take my free cash flow and multiply it by 8 for the 8 years that the company has for me to be happy as an investor, to buy back all its shares and pay off its debt. So that's the free cash flow that I want it to generate in the next 8 years. We subtract debt from that to give us the actual share price, the value of the shares, and then we divide that by the number of shares outstanding, and we get a fair share price of roughly $27 is what I'm predicting, or I'm valuing Enerplus to be at if WTI stays at 70.56. If it goes to 80, that's the number. If it goes to 90, et cetera. And that's basically it. That's how I value these companies. And something I will say is that this is not an absolute number. I don't just buy a share and say, hey, this is what I'm expecting, and I'm not going to sell until I get to this. No, this tool is a relative valuation tool. I'm looking for companies that have the best undervaluation potential currently, that are, Enerplus is at roughly $13 a share. So I'm saying it's roughly 50% undervalued today. There's companies we've discussed in previous seminars that are 75% undervalued, that are 80% undervalued. So, I find my top 5 or 6 or 8 companies, and then I will do a deep dive on them. What's going on? How are the management? What's the dividend stability? How is the reserve life looking? is their operating costs increasing in the last couple of years? Have they made acquisitions, etc.? I can go on and on, but this tool gives me a quick and dirty method to find the top 4 or 5 or 8 most undervalued companies that I want to focus on. So does that make sense to everyone? Is there any questions, comments, feedback on that?
Could I don't know if you can hear me.
Yeah, go ahead.
Oh, thank you very much. I thought that's a wonderful explanation. But could I ask, this seems to apply really for shale companies. Would you apply the same thing for offshore companies or for conventional production? What I'm thinking about is that for some of these companies, OPEX and the Capex element is going to be significantly more variable.
Yeah, so great point. And you could say the same for oil sands companies, which have these huge projects that require massive Capex, and it doesn't start generating cash flow until years down the road. Same with offshore, same with conventional. So you're absolutely correct. And this model, as it sits today, is not for companies like that. It's for companies which really, I would say every company in the Canadian oil patch today, which is kind of the sector that I focus on, are not putting in any huge oil sands mines or offshore, development, exploration. None of them are really doing that. So this model, I think there's about 55 companies that I track in the Canadian public markets, and it seems to apply for all of them. Now, if you want to run this for a company like Hess or ExxonMobil or some of these companies drilling in offshore Brazil, some of these Russian companies that have these hundreds of billions of dollars of projects, yeah, it's really not the right way to value them. However, the way that I would value those companies is I would take the full Capex that they're going to spend, and I would add that to my current debt number, and then I would run the valuation as if the project is already online. So I would put in a certain number for production, that okay, they're going to increase production by 200,000 barrels a day, so that's what I'm going to put in here, and then go through the same calculation. And the only thing you would have to do manually is that you take this last quarter's free cash flow and you say, okay, in 2025, the company is going to generate an extra 100,000 barrels a day. I think they're going to make profits of $30 a barrel. So you take 100,000, you multiply it by 30, and you multiply it by 365, and you put that number in addition to your free cash flow. So you can almost, instead of doing this valuation on a previous basis, you're going to do it on a forward-looking basis. And the same concept applies. It just requires a little bit more manual work, but I hope that answers your question. So it's not bang on accurate for those companies, but you can make it accurate by looking at forward projections instead of last quarter results. Perfect. So unless there's any other questions, I'll continue on this one. There's a couple people in the Twitter space, etc., and a lot of funds that use annualized or adjusted funds flow instead of free cash flow for the exact same reason that you mentioned, is that capital is not really consistent. A lot of gas companies are drilling their wells in the winter and they spend no money in the summer, but they get these huge cash flows from the new production that came online. So, free cash flow, maybe you don't like it because, it's just too detailed and too volatile from quarter to quarter. So you can use a adjusted funds flow times 4 multiple instead. And which is better? It all depends how much time you have to spend on the company. If you're someone who's worked in the industry, you've been investing for years in this sector, you understand the capital requirements of certain companies and how they kind of fluctuate, and you can kind of add your own subjective, bias to it, I would use free cash flow. It's a much more accurate method if you can account for some of these things in your head. But if you're kind of more of a generalist, you just want to know what's going on a not worried about Capex. You don't want to look into drilling results. You don't want to look into how the Capex varies quarter to quarter. Adjusted funds flow might be better for you. And, I use adjusted funds flow times 4. Some people use 6. It all depends how conservative you want to be. And again, you don't have to do anything. The spreadsheet will calculate all this for you once you have the yellow boxes filled in. And again, it's about $16. It's telling you is a fair share price. So, if you're using this method, Enerplus may not be a company you want to really look at because it just does not have that much value left compared to what the numbers are telling us. And just to go back to this part for a second, make sure your percentages of your production add up to 100%. AECO, NYMEX, and other gas, make sure that they add up to 100%, or else you're going to have some errors and miscalculations in here. So anyway, this gives you basically everything you need, and depending on which model you're using, free cash flow or adjusted funds flow, you run the same model on the 5 or 10 companies or all the sector if you want, and you find the companies that are most interesting to you, and then you do a deeper dive. You see what's going on an operational level, dividend, etc. Keep in mind, these numbers are pre-hedging numbers. They don't take into account hedging. This is as if the company is into the future, has the optionality of hedging or not hedging. So if we want to look at it from a hedging perspective, just for 2022, let's say you think, hey, I don't really want to hold these companies for too long. I don't believe in the macro. I'm going to hold them for 2022 and see what happens. So I want to look at the hedging for the next 1 year only. So, we'll go back to the corporate presentation. At the bottom here, we have our right here. We have our commodity hedging summary. So basically what this is telling you is how many barrels they have hedged and at what price. You need a little bit of understanding of how hedging works, especially these 3-way collars and these what do you call these? These two-way collars, I guess I'll just call them for now. But once you have an understanding of this, you can really dive deep into, okay, how much money is the company going to lose or make over the next 12 months? So since Q4 is almost over, I'm not going to take into account the hedging in Q4. It's really not important to our valuation of 2022. I'm going to look at risk management hedging contracts for 2022. So they have this contract for the first 6 months of the year. They have this contract for the first 9 months of the year. They have this contract for the whole year. So you need to do a little bit of math on some of these companies. They get into these really complicated hedging contracts. But if we look at Q1 of 2022, they have 12,500 barrels hedged at, right now they're going to be getting paid $75 for them because this option is out of the money and it's not going to be exercised. So getting $75 on 12,500, they're getting $42 on 4,500, and then this contract is also active, so they're getting on 17,000 barrels, they're getting $57.91 because this contract is in the money today. So you average those out. How many barrels is it? Well, it's 12.5 plus 4.5 plus 17, 34,000 barrels. And what's the average price they're getting on this hedging? Well, they're getting this this pricing for this much for this much, and then this pricing for this much. You average it out, you convert it to Canadian dollars, and I'll just open up my hedging sheet. So what I calculated is they have 34,000 barrels hedged at roughly $70 Canadian. Same with Q2, and then in Q3, this contract ends at the end of Q2. So you take that out of the equation. These 12,500 barrels come out, so you only have 21,000 hedged, and then Q4 is 18,000. It's the exact same calculation, just with different contracts. Pricing, you do the same for gas, and this is what you end up with, is that the company is going to lose $200 million at last quarter's pricing because of this hedging. On the gas hedging, they're going to lose $7 million. So what is their hedge adjusted free cash flow for 2022? It's a yield of 17%. So it's gone down from 22% to 17%. Again, just for 2022. If you're a long-term holder, you may not care about this hedging. It's a 1 year period. You believe in the macro for 5 to 7 to 10 years. You're not worried. You know, maybe this number means more to you. But if you're a short-term holder for 6 months or for 1 year or for 3 months, you want to look at the free cash flow after hedging, because this is the reality. These are contracts they are forced to be liable for. So, you know, for the next year, that's how much cash flow, free cash flow Enerplus is going to generate. And, you know, 17%. If you can find companies that you're interested in that have more than 17%, maybe those are the ones you look at deeper. If you can't, this is the one you look at deeper. So that's kind of all I do. I do this for all 55 companies after every quarterly result, and I'll find my top, 5 or 7 or 8 plus ones that I'm already invested in, and I'll restructure my portfolio around that. And maybe there's companies that, even though they don't have high free cash flow yields, I like them better because the management has performed as to what they were saying a little bit more. Maybe their dividend is a little more stable than some other companies. Maybe they have some exciting potential coming up that is not shown by this simple calculation. But that's the way I do things, and I find my companies and then I invest in them accordingly and adjust my portfolio based on that if it needs to be adjusted at all. So yeah, are there any questions, any comments on that? Anyone following along that had any problems with the spreadsheet or anything like that?
Yeah, I just wanted to see if we could get like some of the feedback from some of the other guys, especially the guys that, with boots on the ground, maybe guys like Peter, in terms of the presentation or macro outlook versus some of the numbers that we ran here. And if there's anything that, stuck out at them or jumps at you, or many different, aha moments or things that you can tie together, or insights that you could share with us based on, the presentation thus far, maybe any other individuals that, work day to day on site and are seeing some of the things and see a relationship between especially the macro outlook of the presentation.
Hi guys. It's Peter here. I honestly thought you did a really good job at covering that. The macro outlook. The one question on the valuation here that just came to mind as you were going through it towards the latter part of hedging. How do you look at, and this would be more to the companies in the WCS world. When you see like Trans Mountain going down, and you see the spreads or the diffs kind of blowing out a little bit, and now they're coming back, to where we'd expect them to be. How do you value that in the short term, or is that not something you really concern yourself with, being that you're looking at the historical hedge losses? But on the current quarter, if one was to try and put that in, how do you look at that? So
yeah, certainly. So that will be the next step in this spreadsheet that I'm building out will incorporate the WCS oil and then the differential hedges on that oil. And I think that's very important because companies can get absolutely slammed by these short-term dislocations. And it's happened many times now, like 2018, December was probably the worst of them. But even recently with this Trans Mountain issue that came up, you know, that being said, it's not really something I can predict, given that this is a future-looking model for the next year. The next spreadsheet will have a diff number in there. So if you think like, hey, TMX might come online on this date and blah, 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 and you know, you look at all your factors and you think, hey, the actual diff is actually only going to be $11 instead of $16, you will be able to put that in and the spreadsheet will account for that. That being said, as far as like the valuation goes, it's very subjective. Like I will keep in the back of my mind, okay, this company produces mostly WCS and they don't have the firm egress contracts. So that is a risk to take into account. So even though that company might show me a higher free cash flow yield, I might say, you know, the risk is just too much of that. A lot of that risk has been kind of mitigated given that we have excess egress today where we sit on WCS. But definitely it's something that if you're someone who really wants to understand these companies, is very important because the diff can make a huge impact. Like WTI could keep rising and the diff could blow out to $30 and you're making no money on the WCS barrels. So yeah, does that kind of answer the question or?
Yeah, you bet. I mean, I just kind of factor that in if, you know, if you're investing or you kind of, you know, keep that in mind. You know, it's probably very hard to spreadsheet because of volume and you know, the day to day, but it's just something like if I look at just the last quarter that we're, you know, if we're looking at the Q3 results, I'm anticipating come Q4 here, some of these companies will have slightly, you know, weaker numbers because the differential certainly was quite tight in Q3, but it's blown out a little bit in Q4, even though the average price of WTI might be pretty close to the same. So I just keep that in mind. I don't, you know, it doesn't need to be scientific. It's just, I was just curious if you're, you know, how you looked at that, but you answered my question. Thank you.
Yeah, certainly. And no, yeah, thanks for sharing that for sure. The WCS as a Canadian producer is very important, and not just WCS, but with Trans Mountain going down, we saw light oil blends start to blow out to numbers we haven't seen in a while. So, you know, like definitely if you want to look at Q4, and then it'll be very interesting to see what those numbers actually come out as. You know, but yeah, these are things you need to keep in mind. Like if you're investing in these companies, it's important to have at least a little bit of knowledge of, okay, how much of their oil is subject to WCS? How much of their gas are they consuming internally versus selling at NYMEX or AECO or Station 2, etc. But you know, like for me, I don't do those calculations very much until I found my companies. Like, you know, for me to run into Enerplus and say they're selling 2% of their gas at AECO and take that into account, whereas, you know, I run my calculations and I find 10 companies that have a higher free cash flow yield, I'll go into those companies and then do that kind of in-depth research. Because if it's a company that is not generating the money that I'm looking for on a historical perspective, and it's a big difference to other companies, it's just not worth the time. And I don't think any of us have the time to do that. But once you find your companies that you're like, hey, these 5 companies I'm comfortable with, they're generating gobs of free cash flow, absolutely, you need to know what's going on. You need to know how much storage they have, how much pipeline space they have, what kind of contracts are they forced into. Like, you know, there's companies out there today that don't produce the barrels that they've said that, okay, we're going to ship these many barrels and this much gas come 2023. So, you know, that company may generate a ton of free cash flow, but a lot of that has to go back into capital to maintain these take or pay contracts. So, you know, some of the nuances are, you really need to understand the industry, but for what the spreadsheet is built for is kind of an initial relative valuation across the industry. And you will find there's companies that are trading at 5% yield, 17% yield, 40, upwards of 30, high 30% yield. And after that, it's all subjectivity. Do you want to invest in a company like Enerplus that's more safe, that's bigger, or do you want to invest in a micro cap that has higher free cash flow yield? That is a question every investor, you have to do your own due diligence and your own subjectivity, look at your risk reward, and then go kind of based off of that from there. But yeah, thanks for sharing that point. Appreciate that. So if there's other questions or comments, we'll take about a 10-minute break. We've been at it for about 2 hours here, and then we'll resume at maybe 2:25 Mountain Time. We'll come back and we'll do CNRL, which is the big boy of the big boy in the Canadian patch, and then we'll do InPlay Oil, which is a company that was the most suggested to me on the Twitter poll slash post. We'll go through those two, and then after that we'll open it up. But unless there's any other comments right now, we'll take a break and then reconvene in about 10-12 minutes here at 25 minutes past the hour.
I just seen Dave Curl unmute his mic real quick when we asked the question. Dave, did you want to say something?
No. I mean, sorry. All I was going to say was I thought you asked for comments about the macro bit at the beginning, which I thought was very good. They were fabulous charts. There were a couple of things. I arrived late, but there were a couple of things which kind of I hadn't seen, and that is, of course, Iran coming back online, and Iraq coming back online, and Libya. So, they're three potentials which are sort of obviously have their own problems and are unknowns. But, that and Venezuela, it's not that there isn't enough oil, it's that there's not enough produced oil at the moment on the market, to get to market.
Yeah, certainly. And this was a question that was asked last time as well, and I should have maybe spent a little more time on it. So as far as Iran goes, I think a lot of the barrels are being sold already in the gray market, and what isn't being sold to China with these false flag tankers is going through Iraq and being shown as Iraqi exports. Is there more oil there? Certainly. Is it going to come online? They haven't really been investing in their oil industry when there's no market for it. So a lot of this stuff has been laying around, shut down and such. I don't have enough insight on that to really comment, but there is some potential there. How much? I don't think very, very much overall. Venezuela is one that, okay, people could really start investing in Venezuela and jack up production, maybe 1 million barrels a day next year. Is it going to happen in the state that the country is in? I really don't see it. You would need someone to take a massive risk on that and assume that they're not going to get, kicked out after everything's running and such. So yes, that is another option there. And then as far as Libya goes, it's geopolitics. It's something they haven't figured out for a long time now. And again, when you don't maintain an oil field, when you don't give it the care that it needs, it cannot produce to the numbers that people are using from 5 or 7 or even 3 years ago. So yeah, you're right. There is some oil out there, and if oil really spikes to 100 plus, 120, 140, could some of this oil come back online? Certainly, it could. But can it come on as fast as we would like it to? Maybe not. But yeah, amazing. And the next seminar that I'm going to have in early January, I'm going to do a much deeper dive on this hidden spare capacity / gray barrels out there, and really happy to share that once I've done that, and really appreciate you bringing up that point. That is the one issue that could cause a dent in this thesis, going forward. But yeah, there's a couple of comments here in the chat on Venezuela oil production and such. So yeah, if anyone wants to read that, feel free. But yeah, thanks for sharing that, Dave. And we'll reconvene here in about 10 minutes, and then I'm happy to discuss more questions on the macro then. And then we'll follow along with the other valuations at that point. Zauzi, did you want to share some information on Venezuela if you've read the article and maybe offer some comments on that?
Oh yeah, I just I actually discovered this a while ago because I was curious because there's not much information on Venezuela because production has declined like 70%. But I was just reading about it on the political and economic crisis there. You know, I work in the refineries and stuff and, you know, pipelines and stuff. I mean, if I don't know how bad it is, but if, you know, if it's as bad as I think, you know, to ramp up the previous capacity may take a decade. So, you know, this is a huge, this because the thing is, it's like a very unstable society. You need to bring in a lot of experts, a lot of foreign materials, lots of construction, right? And if all that steel is rotten, you basically have to replace everything. And a lot of the mega projects can take, you know, 5 to 10 years to complete.
Oh, very interesting. Have you done like similar analysis on across the whole Venezuelan field, or just this El3L?
I mean, I'm just like, you know, reading articles from news reporters and stuff like that, you know, and if you have such significant declines in this, like I don't really know that much. I just read news and watch a couple of documentaries and what's going on. If this is the state, because they haven't been, my understanding is it's completely dark. And, you know, if you have like literally like oil tanks collapsing or stuff like that, this is like, man, this is crazy. Like, and the production volumes have collapsed too, right? And it's also under heavy sanctions too. So they haven't been able to rebuild any capacity, and that's a big problem. I mean, it's different for like a country like Russia because they have a large chunk that's indigenous, right? Whereas Venezuela is entirely dependent on foreign experts, in my opinion. I don't know much about Venezuela. I know a little bit about Russia because I did some reading about it, but they are quite dependent on that. And I think Iran is in a similar boat too. I think the only people there are maybe like PetroChina and Venezuela, but the thing is that Venezuela, if it does come online, is when it does, is extremely bearish for the Canadian oil sands. Because I think a lot of the heavy oil they drill, especially in the Orinoco Basin, is similar to like the stuff with MEG energy. And if they can, because there's also a question of, there's a lot of open-ended questions like labor costs and stuff, because generally their labor costs should be significantly lower than Canada. So that gives them a competitive advantage when producing the heavy oil. But then again, you also have the issue with like foreign import taxes, corruption, and that also raises the real cost of production. So it's kind of an open-ended question. And I think that for them to restart full capacity, it will require like a crazy amount of capex and many, many years because they probably have to rebuild most of their capacity. And, you know, it's going to be a gold rush when it happens too, right? But you just got to be, I think a lot of people got to understand, like, since it's like heavy oil, when they start investing, it's at the highest point of the cost curve with water oil. So when these projects start kicking off, you know, you should start thinking about exiting. That's just my 2 cents.
No, very interesting, and thanks for sharing. And that's totally bang on. It's the heavy oil blend directly competes with the Mexican barrels and the Canadian oil sands barrels. But once again, that being said, it's all about, even if there is a gold rush into Venezuela, how much can the companies investing trust that it's actually going to be their production at the end of the day? It's not going to get locked up with government issues and politics and corruption and, you know, whatever else there's out there. And like you said, the delay to that happening is also a factor, because you can't just overhaul a refinery overnight. It takes many years to go through the checks and make sure everything is running fine. Maybe even not to Canadian standards, but even just to bare minimum safety standards. So great point.
I honestly don't. Oh, sorry, go ahead.
Sorry, I was just going to suggest that, like, we can't even get like safe countries to drill. Like, we can't get banks or any institutions to invest in Canadian oil, or even like really shale for that matter. So I totally agree that like Venezuela is you know, something we have to pay attention to, but it's probably so far down the road. We'd have to see such high and consistently high energy prices that you'd actually warrant investment. Like if shale investors have been like once bitten, twice shy, and then like, you know, fool me once, fool me twice, fool me three times. Imagine about investors in Venezuela when they're taking on that kind of level of geopolitical risk, and they have to do that sort of level of investment just to get an ROI. I agree, but it's just something like I think that's a good problem to have. Like by the time that they're digging into Venezuela again, Canadian oil and gas codes should be trading so much higher.
I'd like to also point out that there's a lot of Chinese capital flows going into, like, one of the few groups that are still actively investing in oil and gas are like Chinese state banks. But if you look at the capital flows, like the majority of it is actually into Russia. It's not into these other countries like Venezuela. Like they do have a small bit of activity there because you read a couple of news articles and stuff. But the biggest flow is actually into Russia because they still have relatively the transportation is far easier Venezuela versus Russia, and they have existing infrastructure, and it's just there's a distance thing, and also there's still quite a lot of reserves in Russia, but it's mostly in the Arctic, so it's on the higher cost curve too.
Yeah, certainly. It's about who's willing to put the money in for that long-term payout, and then that's really what'll tell you that the bull cycle is in its peak, I guess you could say, is when companies start sanctioning oil sands projects and big offshore developments, and then production that's 2 to 3 to 4 years out. That will give you an idea that okay, they're predicting that the price when these projects come online is still going to be economic. So and that's what it's going to take. It's going to take many sustained years of sales pricing well above economics for companies to justify this sort of development. So yeah, great point. And then like you said, globally, other than these Chinese state banks, maybe there just is no appetite to ramp up these long projects with no understanding of is the money put in actually going to be given back at all, let alone any profits coming out of it. So there's a huge risk, and I think a lot of banks, American banks and then Canadian banks, just don't care anymore, which is very, very bullish going forward, not only from a supply standpoint, but also because as the companies delever, they control what's happening. It's not, you're no longer subject to bankruptcies and random hedging being forced on you by these banks and funding groups. You control your own destiny. And as we know, a lot of Canadian producers can pay their dividend right down to $35-40 a barrel and keep production flat. So if they're fully delevered, it's not even really a risk. You're really buying very stable cash flow generating entities at that point.
I agree completely, but I think Venezuela is actually really a contrarian indicator, because when these projects start actually coming in line in Venezuela, I'm dumping everything. I'm just making that public. I'm selling everything I own, especially Canadian stocks.
When the projects come online, like when they actually start producing oil, you mean?
Oh yeah, because they're just gonna have massive supplies, right? Especially because it's heavy oil sands. These are long projects like Mac Energy or like the oil sand stuff. So that means it's gonna be a flood of supply coming online. But that's usually at the end of the cycle when they start sanctioning and building all these projects. And if they start talking about actually a good section on oil I read in the book The Capital Returns by Edward Chancellor. It's about financial history. I think in 2011, the CEO of Total went up on the world stage and said oil will never drop below $80 a barrel. And they were sanctioning all these crazy projects with break-evens about $100 to $110 a barrel.
Yeah, well, that didn't turn out very good. So I guess just to follow up on that, what's the earliest you see any of these projects coming online in Venezuela? Like 5 to 10 years at least, you would say, or even longer?
I mean, this is like a work in progress. I don't know much about Venezuela. Like I said, I just read a bunch of news articles and try to piece apart a bit of the global energy space, especially in regards to, like, let's say Russia or Brazil and stuff. Venezuela, because it's just like a humanitarian disaster. This could take, I don't know, it could take a decade, in my opinion, but I don't really know much. I just know that I think it would be similar for Iran too, because they've been shut out of the market. You really need, well, I mean, there's they can bring up to some capacity with like other countries, like especially with Russia, because they're actually indigenizing a lot of the energy industry. So like they're to reduce their dependence on foreigners. But the thing is, like, I think they're pretty good with, like, conventional plays, but unconventional is really the technological frontier of the energy industry. And a lot of that is actually in Canada, but it's kind of like, we're going to see. And I don't think this is going to change probably for the next 5 years. It's a personal opinion, but it could, if oil hits like $200 a barrel, like obviously, that changes everything, right?
Yeah, certainly. It's all about where the spike gets to and what the sustained price is. Like at $200 a barrel, you will see projects being sanctioned. But again, if it's not going to stay there for 3 or 4 years while the project gets built out, companies still might not invest. So it's a pretty interesting one. And like I said, I do want to do more research on this, and on next seminar share on these gray barrels a little bit more. So yeah, certainly.
Just to end this little conversation off, one thing I kind of read up about was coal to gas transition, because I think there's a company in South Africa, Sasol, that does this. Is they convert coal to synthetic crude oil, but I think they only really started doing this around like 2010, when oil was really crazy expensive. And back then, the break-even cost was about $110 a barrel. So that's one thing to look out for, is because when crude oil gets so expensive, there is an alternative to take cheap coal. Well, I don't know how cheap it is anymore, but cheap coal and convert into crude oil at a set break-even price. But that's a very high price. You're talking $110 break-even.
Yeah, that's interesting. And like you said, it all depends. If the price of coal, if the input price has gone up, then that price has gone up. And then secondly to that, how many barrels can they really produce on a short-term time frame? But all these interesting things to keep in point that are out there but are not economic until 110 or 120 or 130 dollars a barrel, before inflation is taken into account as well. Yeah. So anyways, great discussion on that. And yeah, maybe if you're open to that, I'll be in touch with you on this Venezuela and kind of what you know so far. It'd be good to have a back and forth on that. So we'll continue on. So the next company we will do is CNRL, the blue chip of the blue chips. And the idea for this kind of came out. We had a Twitter Spaces last Sunday on large caps versus small caps, and there was a lot of support for CNRL, rightfully so. They're one of the only companies that did not cut their dividend in 2020. They actually increased it, and they have further increased it recently here to almost 60 cents a share, I want to say, quarterly, which is just phenomenal for a company that was trading at $9 in March 2020. So yeah, this one's pretty interesting. CNRL does not show their numbers as easily as these other companies. It's a very convoluted company. They have a lot of operations all over the place. I haven't owned CNRL stock, full disclosure, in quite a while. Perhaps that was a mistake, looking at their performance kind of since the pandemic. That being said, I think once we go through this calculation, I can kind of justify it more as to why at today's pricing, there might be better names out there with higher free cash flow yields. However, for investors that are looking for the stability and the big power, low risk kind of holds, this is where the subjectivity really comes into play, as to what exactly you're looking for from your investments. Are you looking for the slow, stable growth that is repeatable, or are you looking to hit home runs here with this oil boom? The oil structural cycle that we're on. So same thing, CNRL, put the company name in there. The production numbers are in our Q3 results. Again, we have page 3, 1,237,503 is the BOEs. So I'm going to put in exactly like it is. 1237503. We have our crude oil numbers is roughly 952. The company doesn't tell us what the percentage is, so you just play around with the numbers or you use a calculator. It's about 77%. 952 roughly. Shares outstanding. So shares. So this is page 44. Again, this is where CNRL really is. It's hard to read their Q3 report. It's very long. It's very detailed, and all the main numbers are not at the top. That being said, it's not a huge deal. Like I just go Control F and search for what I'm looking for instead of scrolling through 70 pages to look what I'm looking for. So there was roughly 1.176 billion shares. So I'll put that in there. The share price on Friday, I actually don't know what the share price was of this one. So 52.97. So we'll put that in there. Again, we got our market cap. Current debt will be net debt. So ending net debt at 15.9 billion. So I'm going to put that number in there. So 15.9 billion. We got our enterprise value. And so let's compare to Enerplus. Enerplus had roughly 0.23 debt to EV ratio. So out of the entire value of the company, about 23% is debt. CNRL is roughly 20%. So, you know, pretty similar companies to compare compared to other companies, you know, like Surge, for example, or Vermilion that have much higher ratios. So if you're looking for maybe a safer company, you want to look at this number and you're happy with the debt, kind of where it is relative to the total value. For CNRL, debt capacity, I don't think is a problem. It never has been. So I'm not even going to look into it. You know, they're such a powerhouse that they have access to all kinds of capital markets that other companies maybe do not. So I'm not going to look into that. Safe Black Capital. Let's see if I can find this. So actually, I'm going to look into. I don't know if CNRL has released a 2022 budget yet so far, but I know there's a slide in here that shows right here. So the capital 2021 final was roughly about, you know, $3.5 billion, you can say. So I'm going to put that in there, assuming it's the same for next year. The annual dividend, they just increased it. So they've increased it quarterly to 58.75 cents a share. That's quarterly. Again, since we've made this change on the spreadsheet in terms of the dividends being pre-cash flow, I'm now changed my looking into forward dividend yield. So 58 cents, that's $2.34 annual basis. So the company spends roughly $3 billion just in dividends. So something you want to kind of keep an eye on. Okay, can they actually maintain this going forward? You know, just in the back of your head, they're a company that has never decreased their dividends. So it's pretty stable, but you still want to kind of keep these things in mind. Last quarter adjusted funds flow. So adjusted funds flow is $3.6 billion, so 3634. So we'll put that in there. Free cash flow. So the one thing with CNRL and the way they report things is that they report their free cash flow after dividend, which is maybe not the wrong way, but it's not how the other companies are showing things. So you want to read these things carefully and what number you're actually pulling out, given that it may not be the actual number you're looking for. When we look at free cash flow, we want numbers adjusted funds flow minus capital, no dividends or anything taken into account. So the way that I've calculated it here is I take my free cash flow that they reported and I added my dividend that they reported to get my pre-dividend free cash flow. So 2195 plus 558. So that gives me 2753 of actual free cash flow that they made last quarter. So it's looking good. 1 quarter of free cash flow pays off their entire dividend at current strip price. You know, that's a pretty good position to be in as an owner. If you're an investor in CNQ, you know, the dividend is looking pretty safe. The hedging impact, so CNRL does not hedge. As far as I see, they have not hedged all through 2021. And so we'll still look for the number if there is one, and we find, where is it? Right here. So for the 3 months ended September 30th, this is way at the bottom of the presentation. Risk management activities, they made $4 million. So for a company of this size, their hedging is really not substantial. They really don't hedge very much. So, you know, $4 million, you know, you can put it in there, you cannot. It really doesn't affect the calculation. It's so little. Share buybacks. So again, search for the company you're looking for, or the whatever you're looking for. There's no point scrolling through the entire presentation, especially quarter after quarter. Once you read through it once and you understand the company a little bit, or twice or 3 times, you know, I just look for the numbers that I'm looking for. So share repurchases in Q3 at this price, this many shares. So it's 11.98 million shares at $42. They don't give me the dollar amount, so I'm just going to calculate it. Number of shares multiplied by the average price paid per share, and I get 507. So I would put 507 in there. So you know, looking pretty good. They spend about, this is a company that is already spending half its free cash flow on dividends and share buybacks. You know, their free cash flow is 2,700. If you add the dividends and share buybacks, it's roughly 1,200. So this is a company that is very, very strong. They tell you what they're doing and they do it. They haven't cut their dividend. They're buying back shares. They already pay out a bunch of money to free cash flow, to dividends and share buybacks. They're making really solid acquisitions, as they always have. So I can see why people like this company. There's nothing out of the blue that comes out and kind of catches you off guard. But you know, let's keep going. So we want the benchmark pricing. You know, crude again, benchmark pricing, WTI 70.55. So I'm going to put that in there. Strip pricing we calculated earlier was 70.3. Other free cash flow sources. So what you could do here now is you could look at the recent acquisition of Storm Resources and put a number in here based on that acquisition. However, I think the company is just too big where that acquisition really is not going to affect our end calculation very much. So I'm going to leave it out for now. However, that is something that you want to look at. Any acquisitions that they've done that add to free cash flow next year, you do want to put that in here. CNRL's production is mainly in Canada. I'm sure they sell some of their gas into NYMEX and Station 2 and such. I was not able to find the data in their presentation or in their Q3 report. So we're just going to assume that all the gas is into AECO. Again, gas is not a huge revenue stream for these companies. So for us to go nitpick where exactly the gas is being sold at, unless it's European gas, the natural gas hubs in Canada and the US are almost pretty much at the same pricing, give or take $1 here and there. And it really doesn't make a huge difference to the end result that we're looking at. So for this quick and dirty calculation, I'm just going to find the AECO benchmark that they got for Q3 was 336. I'm going to pump that in there. And then the projected AECO price, I believe the last time I checked was roughly 365, I want to say. 335, sorry. So AECO has dropped a lot as we discussed in the macro outlook. So 335, it's about bang on the same. If you think AECO is going to average something different, if you're the guy reading models and weather trends and such, and you think AECO is going to jump to $7 next year, feel free to put $7 in there. This is a projected AECO price. So that's all you need. It took 5 or 10 minutes to do all this, and we end up at our numbers. Annualized free cash flow yield. So, compared to Enerplus, which is at 21%, we are a little bit lower, and our fair share price kind of reflects that, where we don't have much upside to go using this 8 times free cash flow valuation. And if you look at the 4 times adjusted funds flow valuation, we are very overvalued already on this company. But again, this is a company, people don't hold this to be batting home runs out of this company. They want to invest their money in CNRL, they want to leave it be, and it just pays them dividends. They buy back the shares, they make strategic acquisitions, and they can leave it without thinking very much. So the subjectivity of what do you want to do with your dollars you're investing comes into this equation. And a lot of bigger funds and banks and such are happy with 14% free cash flow yield if they can have the stability of the company. But on a valuations model, I cannot justify investing in this company going forward because, even at $100 oil, I see roughly a 3 times potential. And we look at Enerplus, we're at, more than 4 times, almost 5 times potential. And then you look at other companies that I've discussed earlier in the other seminars, we have a 6, 7, 8 times potential. But again, it depends why you're investing your dollars. Are you looking for the stable growth? Are you looking for the home runs? And you can make a case both ways, depending on your risk reward, kind of what you're looking for, and how you see the macro playing out. And because CNRL doesn't hedge, very, very little, I'm just going to leave this, and these numbers will be the exact same that we calculate here. Any questions on that?
Hey, Shabam. Do you mind if I have talk about a few comments I have about CNRL?
Yeah, go for it. Yeah.
I think the reason they don't hedge is because the majority of their production is synthetic crude oil, and that comes out of their flagship Horizon and AOSP plants. And AOSP break-evens are very high, but the Horizon plants cash cost is approximately, I think the lowest they achieved was about $19 Canadian per barrel of synthetic crude oil.
Wow.
So I think that's one of the going forward is they don't really hedge because they can produce it for a very low price and have a long longevity. And there's also the fact that they could actually increase capacity because they have such long life reserves. There's nothing stopping them from increasing Capex to double their capacity, for example, and produce far more oil. And but that's also based on supply constrained pipeline capacity. But I'm just pointing out there's also possibilities what they can do, and they generate so much cash that they could do crazy things with it.
Yeah, no, appreciate you sharing those thoughts. And CNRL is a company I have never done the deep dive on. So there's a lot going on with CNRL that are positive, that are kind of like hidden gems in there, which I really have not looked into. It's a company that's so big that you really need a lot of time to look into each of their segments and and what they're doing. And for me, it just does not generate the free cash flow that I'm looking for. So I've never done that. That being said, I think, there's a lot of investors who have very in-depth knowledge about this company. So, if you're on this call and you have some information you'd like to share, feel free to do that. And if not, on the next Twitter Spaces, that is something I want to discuss with some of these people who are invested in CNQ, and if they've done a deeper dive, and what do they see are some of the things that this basic modeling misses. And then I would say the stability of their dividend, the strength of their management, the opportunity that they acquire companies, they always win. They never have lost out on an acquisition. It's always at valuations you would think are just not possible. So there's a lot of benefits to owning this company that are not reflected here. But I'll be straight honest with you. I've never done the deeper dive on this company because it just does not generate the free cash flow that I look for.
Just for personal reference, I own the majority of my energy stake. Actually, a large part of it is CNQ, because I have friends who work for CNQ, and they work at the Horizon plant. That's why I ended up buying it, because I asked a lot of questions, and they have a lot of I think decommissioning for this asset, for their flagship assets, probably around like in the 2050s, maybe 2053. So they have probably 30 years of reserves at current run rates. But the issue is, like, do you really want to run at this, production rate? Because if higher oil prices come, they're going to increase capacity, right? And feed into it, because they can, sell it for much higher prices. And also, I've learned the chairman, Murray Edwards, is he's a very interesting character, especially with the dividend, because he owns a very, very large stake, I think like 2 or 3%, and he collects a lot of dividends personally. So the management team is very for the dividend, because they own, there's a lot of insider shareholding. On the negative side is one of the ways their salaries at CNRL are okay, but the real kicker is for bonuses. CNRL gives a large chunk in share-based compensation. I think one year it hit like $300 million. So that's something to watch out for, especially when the bull market goes on. So there's a lot to unpack, and especially in regards to Murray Edwards and his team, they're they are, like, from what I read about them, they're like the best guy. They're specialists in distressed acquisitions.
Yeah, and we've seen that over the last 18 months and over the last 10 years, really, like, if not longer. It's every distressed asset gets bought out at a very good valuation. They're able to synergize it right away and start generating gobs of free cash flow. It seems to be a very good business model for them that's been working fantastic. So yeah, like you said, the strength of the management and the stability of their cash flow payout is something that a lot of investors in the energy space are looking for, given that how volatile the industry is, and how difficult it is sometimes with all these bankruptcies and junior companies and et cetera, coming in and out. So yeah, right on. Any other thoughts on CNRL? Anyone wants to share anything? And if not, we'll move to IPO, InPlay Oil. Perfect. Okay, so the next one will be InPlay Oil. This was, again, a company that was recommended or suggested many times, and they've gone through a recent acquisition. So when a company does a recent acquisition, what I do is sometimes I look at the Q3 results and then try to add on what the acquisition impact is. In this case, the acquisition is pretty impactful on InPlay Oil. They go from a company producing 5,700 barrels to 2022, they're projecting upwards of 9,400 barrels. So it's not really an acquisition, it's a merger. And for companies like that, I want to look into the future. I want to look what's going on a future basis, because the previous numbers really don't mean much. When the pro forma company is only reflected 50 or 60% by the Q3 results. So with InPlay Oil, what I'm going to do is I'm going to look at what's happening into the future. So I'll go to the corporate presentation, and they have a pro forma corporate overview of what's going on. And they also have a preliminary 2022 pro forma outlook at 69.75 WTI, which is two things. A, it's the same as Q3 almost. And B, it's the same as strip pricing. So like, this is a really good time to go through InPlay, because the numbers that they give us, we don't really need to adjust it. We only need to verify them and then go from there. So 89 to 9,400 BOEs, I'll take the midpoint. I'll take 9,150 on that. And about 64% liquids, I think they said. Yep. So I'm going to put that in there. Shares outstanding, pro forma shares outstanding are right here, 86.2 million. So with InPlay, there is about a 7 to 8% difference between basic and fully diluted shares. Which one do you want to use? I still like using basic, because those are the actual number of shares out there today. Some people like using diluted. Well, some of these dilutive instruments are like till 2024 or 2025. So to use them in the calculation today is not really accurate either. And I'm going to leave it up to you guys, or whoever's attending the call, what number you want to use. I like to use basic, keep it simple, and that's the number I'm going to use here. The share price Friday closed at 192, so market cap again is that, and our net debt 76 million. It's all there right in the corporate presentation, easy to see. So we get enterprise value, debt to EV. The debt to EV is higher than Enerplus and CNRL. So you need to be taking on a little more risk as to their debt situation. Still nothing crazy compared to some of the other companies we've valued in earlier seminars, but higher than the big boys and the big players. The debt capacity, again, I don't think it's that important with this company, just because they did the recent acquisition, they increased their line of credit. You can put it in if you'd like. I'm just going to leave it for the sake of time. The stay flat capital that they're saying for next year. So the adjusted funds flow for next year, what they're projecting is roughly 109 million for the year. So what I'm going to do is divide that into 4. So I get for my next quarter adjusted funds flow, because they did an acquisition that was so big, I'm going to look into the future now. I'm not going to look at the past. I'm going to look into the future. So 27.25 times 4 gives us the midpoint of their projection here. For the free funds flow, it's about 57 million. So same thing. You want to divide it by 4. I believe it's 14.25. So the capital is roughly $13 million a quarter, which is a difference between these two. Annualized, that's about 52 million. Does that make sense, that the math that was done there? And how we came to that number? Yeah. The annual dividend, 0. Nothing to take into account. The hedging impact, again, because we're looking forward, it's not important. These are 2022 projections. Share buyback is not important. We'll put the strip pricing in. Other sources is 0. The gas production. So for the gas production, I will go back to the Q3 report. We'll say 100% was AECO. The gas price and the benchmark pricing, you don't need to go look at every company over and over. It's always the same number, because WTI and AECO are traded commodity contracts. So if one company has found WTI to average 70.56 for the quarter, that's what they're all gonna show. So I'm going to use CNRL's gas number, 336. And again, I'm going to put in my projected AECO price, 335. And the one thing I will do is management can say whatever number they want here in terms of their projections. Is it actually achievable? So I'm going to do a check on that. So I'm going to go to the Q3 results, and I'm going to look at adjusted fund flow. Was roughly $15 million, 15 and a half for the quarter. In my mind, I'll say, okay, annualized, that's roughly 62 million. And then, they're going from 5,700 barrels to 9,000. It's roughly about a 40% increase, about a 60% increase in their production, 50 to 60%. So I'll take my 62 million and I'll multiply it by 1.6. I get roughly 100 million. It makes sense. There's a little bit of synergies there. They can reduce their interest costs, maybe. So I'll give them the benefit of the doubt on this and say, okay, this is probably in a pretty reasonable range. Maybe it's overstated by a little bit, but we'll give them the benefit of the doubt on this one. If you want, you don't believe them entirely, you can knock off 10 million, so $2.5 million, knock it off this number and this number, and the projections will change. I'm going to leave it as is. If you want, you can adjust it when you run your own calculations. So that's it. That's all you have to do. And we get a free cash flow yield of roughly 23.6%. What happened here? So much higher. It's much higher than CNRL. It's about the same as Enerplus. What are you getting? You're getting a company that's maybe a little bit smaller. They can grow faster. Potentially at higher pricing, they could grow faster. Compared to Enerplus, they don't pay a dividend yet. So you might say, hey, I think they're going to start paying a dividend. So I'm going to play InPlay oil, because when the dividend announcement comes out, the share prices have been seeing a boost. So compared to Enerplus, which is already paying that, I have that excess, catalyst to me. They're not buying back shares, so I have that excess catalyst to me. So again, subjectivity matters. InPlay oil, as far as I know, they have very little hedging for next year. So again, the hedging does not impact what's actually out there. So where am I here? Yeah, so I'm going to leave that out there. And one thing I will say about InPlay oil is that their capital efficiency is very, very good. So compared to a company like Enerplus, where their free cash flow yield compared to their adjusted funds flow yield is only a little bit higher, which means they're spending a lot of money to keep production flat. Whereas InPlay oil, it's almost double. So, again, if you think InPlay oil can grow production, they are able to do so at a very, very good capital efficiency compared to some of these bigger companies. So, you want to play a growth play, or you want to use adjusted funds flow multiples, you get much more torque using this method compared to the other companies. So again, these are things that maybe are not obvious, but if you run through both of these, you kind of compare the numbers, it becomes obvious that Enerplus is spending a lot of money to keep production flat, whereas InPlay oil is spending much less money, much less capital to keep production flat. And maybe that's the play you want to take. Yeah, so I'll open it up. I know there might be a few people on here that own InPlay oil. If you want to share any thoughts as to why you own the company, and maybe some things that for me, I haven't done a deeper dive on it, so I don't see those things. Or maybe what do you think about the valuation that we ended up at compared to what you expected maybe? No, nothing. Cool. Well, yeah, that kind of concludes my part of the seminar. This will be the last one for the year, as I mentioned, because the 2 weeks from now ends up on Christmas. So we'll reconvene kind of a month, 4 weeks from today, and you know, see how the macro has changed over December and into the new year. See how this whole variant thing comes out. See how jet fuel demand rebounds, and just see how WTI goes, and see how things go from there. If there's any other questions, I'll kind of open it up. There's a chat question here about what I refined in the new spreadsheet. So there's two major things. The one is that I was adding the dividend number to the free cash flow, the total free cash flow, which is not how a lot of the companies are showing their results. A lot of the companies are giving out their free cash flow numbers on a pre-dividend basis. So there was a little bit of an adjustment in the calculation there. And the second thing was that I was not accounting for the exchange rate, because this oil price is in US dollars and this annualized free cash flow is in Canadian dollars. So I just added a little, you know, 1.26 exchange rate multiplier on that. So it does make a difference if you're looking at free cash flow torque to higher pricing. So yeah, see if Russia invades Ukraine, yeah, that'll have an impact. So we see here, David has a comment here that he calculated IPO to have 34.9% FCF at 80 WTI. We're at 34.2. It's about the same. You know, and I think there might be a little bit of difference in the gas rates maybe that you're calculating here, and you know, maybe make sure you're using the actual debt after the acquisition, and make sure you're using actual shares outstanding after the acquisition. So you know, same with production. They tell us the production is 89 to 94. You know, depending on which number you use, it's going to affect your calculation, you know, here and there by a couple percent, and that's all subjectivity. But you know, based on what I see, okay, so spreadsheet. There's a comment here that the spreadsheet on the site is not the one updated. So I just updated that like 20 minutes before the seminar began. So I will recheck it. I will recheck that, but yeah, so the one I'm using anyway has the exchange rate in there, and I will check it again, but the latest version was uploaded like 20 minutes before the seminar began. So if that isn't the one you have, and it's still showing these errors, I'll have a look and I'll update it here in the next couple hours. And just to go back to the other seminars, so this is our potential gains from current share price. So we see Enerplus, we see CNRL, we see InPlay Oil. You know, InPlay Oil has roughly a more than 600% fair share valuation increase at 110. And then, you know, we'll compare it to Seminar 4. We see Vermilion is kind of in the same boat compared to Birchcliff and Whitecap. Number 3, you know, Surge, one of my biggest holdings. You know, I'm playing the cash flow torque at higher WTI pricing on that. You know, we had Gear, Surge, and ARC on that. And then Seminar 2, Crescent Point, Synovus, and Hemisphere. So I'll upload this this entire presentation here also to the website if you want to go through the macro stuff, or just to look at these graphs as well. And yeah, the spreadsheet I'll check, and the video of this seminar will be uploaded kind of later today evening to YouTube again, and it'll be on the website as well. And if there's any other questions or comments, feedback, feel free to email me or say it right now. The mic is open. And otherwise, thank you again for attending. I really appreciate you spending your Saturday and, you know, going through this. And happy holidays, Merry Christmas, and Happy New Year. And we'll see you on the other side.
Thank you, Shabam. This is Sharif. Thanks a lot for this whole series. Great stuff as usual.
Yeah, you betcha. Appreciate your support, and yeah, check out the video, and feel free to share these videos to other people who you think might be interested in them.
We'll definitely do that. Yeah.
Yeah, and then like I said, my email is always open. If you want to even grab coffee, if you want to grab lunch, I'm always happy to discuss oil and gas. And if you've got any questions on any of the names we've discussed, I'm here. And yeah, once again, thank you. And we'll go from there.
Happy holidays, man.
Yeah, you too. Cheers.
Great presentation. Have a Merry Christmas.
Yeah, thank you.
Sorry, if I could I don't expect an answer to this, but I'm a storm resource holder because I held Bellamont a while ago. So I guess my point is, so I've got some cash coming towards me because I'm not going to be a CNR shareholder. So it's up to me, based on some of your presentations, to purchase anything. Do you see CNR buying anything new in that around that area, or maybe just go with maybe your a surge or something like that? Because I am looking for a little bit of a torque to do with my cash from my storm. I'm going to get some money from my storm being bought out.
Well, so
I know it's up to me to decide. Ultimately, it's up to me to decide. But it's convincing what you talk about surge.
Yeah. So like, again, I don't want to offer any recommendations, but like you said, I have this kind of graph for all the companies that I'm interested in. So I'm looking at, if you're looking for cash flow torque, you look for these companies with higher, share price valuation differences at the higher pricing. One caveat is that these graphs are unhedged numbers. So when you look at a company like InPlay, it's completely unhedged, whereas a company like Surge, for example, and the last thing I want to do is down talk my own holdings, but this is unhedged, and Surge has about 50% of its production hedged for Q1 and Q2, and about 25% hedged for Q3 and Q4. So there is a little bit of a caveat there as to the expectations that we put on these companies. I'm more of a long-term holder. I see the potential in Surge, and I've discussed why the Seeking Alpha article has a lot of my kind of conviction on the name, especially now that we've gone through these acquisitions. There's a couple of private equity firms that are closing their doors for good, who were part of these Astra and Fire Sky deals. So their mandate is to dump shares and return the money. So, once we get past that, I see the potential. It's been a long, patient holding game on this name. But once these private equity exits, and once we see more and more eyes coming on the industry, I'm holding strong on that. That being said, there are a lot of names that offer you a lot of torque to higher pricing. Some of the small cap names, and then even some of the bigger holdings that I have, like Synovus and ARC and Vermilion, actually, like this is Vermilion here, this yellow box, and this is pre-acquisition. And after the acquisition, I have even more conviction on this name. I tripled my holding on Friday. The TTF European gas is going crazy, and Vermilion is about 50% unhedged into the new year. So yeah, just some ideas out there. As far as names that are close to storm, I believe it's the names like Crew Energy would be one of the big ones, but I don't see the value in that currently. And my whole thesis has been that as LNG Canada comes closer and closer to launch, I don't think there's going to be very, very many small cap gas names left. I think a lot of them are going to be bought out anyway. But if you're looking for names in that space, you might look at Advantage, Birchcliff, maybe Kelt a little bit, Crew Energy are kind of the names that come to mind. But again, I don't play the gas names as much as I have conviction on the oil thesis. But yeah, thanks for that question. So there's a question in the chat here about Royal Helium and what's going on there and why I'm holding it. So maybe what I'll do is I'll end the recording, and then I'll just stay for informal discussion.